between President Xi Jinping and US corporate executives.
Yeah, hundreds.
US corporate executives, multinationals, and I won't pick on any this morning by name, but I think you can sort of imagine which ones I'm talking about.
Right.
They want two things. One, of course, they want predictable policy coming out of China so they can make really long-term investments. One, without a doubt, and Xi can try and do something about that. I don't think you get that done in one visit. But two, I also think they want better relations from the US side with China because they want these investments to work. This is where they want to produce things. This is where they've wanted to produce things for a long, long time, Lisa, because that's where the people are that can produce these things at a cost that they've been benefiting from for, what, 2 decades?
Have you ever seen Foxconn, what they actually do? They cannot replicate that in the United States right now.
I feel very strongly on this.
From both the expertise as well as just the worker pool and the necessity to pay people, they cannot do this, so they want it to continue. And this, to your point, John, is exactly the problem. They don't want to have to diverge from China because it's a massive market. It's the second biggest economy, and yet they're sort of frustrated by both sides and the sort of social upheaval with people pushing back and different leaders trying to cater to that.
I would predict, folks, in the next 2 years, this is going to be a third rail thing. You can give Bramwell credit for this. I think this is hypersensitive. Can we replicate the labor construct day to day that they have in other geographies, particularly across Asia?
This is where people are hoping automation will come into play, and that will help with some certain things. And again, this goes to the whole investment in the U.S. The question is whether we can afford it, number one. And the question is just, which companies are going to benefit the most.
Look out for that through the week. We'll catch up with Anne-Marie in the next hour. We'll break down some of this. This hour, in about 5 minutes' time, we're going to catch up with Toto Wolff of Mercedes-AMG Petronas Formula One going into the weekend, Tom. This team was dominant for a long, long time. Then a couple of seasons ago had this heavyweight battle with Red Bull. Red Bull's been on top ever since.
There's all sorts of themes here, but John, what's so great here, folks, and thanks to our team for doing this, Christian Horner back-to-back with Toto Wolff, and Wolff is, besides, very much a published a billionaire, he's lectured at Harvard Business School, speaks 14 languages or whatever. This is really the man of Formula One. And he's a legit racer from the past, and he's got what? The worst engineering team on the platform of the, is it 10 teams?
Yeah, I'm not sure I'd go that far.
Okay, I'm asking, you're the pro.
I wouldn't go that far. They're just not as dominant as they were a number of years ago, Tom. He's a legit investor as well. I think you've got to have a broader conversation with him about the business of Formula One.
And Las
also
Vegas,
the business of sports too.
Yeah. Are you going? I forgot.
I'm not. Do you want to make that happen?
I think now we can afford to after
Why don't you check some ticket prices, the airfares?
Yeah, okay, I'll get on that.
We'll try and figure that out.
Lisa
Coming up shortly, Toto Wolff of Mercedes-AMG Petronas on Formula One going into race weekend in Las Vegas. Equity futures right now negative 0.2% from New York City. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support because we are the best investment case for this in the world.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
great track. I mean, it's going to be super fast. There's going to be a lot of overtaking opportunities, and the tires, it could be like driving on ice, which just adds another dimension. So particularly on a road course, on a street circuit, that can test the drivers and the team to the absolute maximum.
Just brilliant to catch up with Christian Horner, the team principal and CEO of Oracle Red Bull Racing, going into race weekend, TK, in Las Vegas this coming weekend. Big conversation about the weather and the temperatures being incredibly low and the difficulty getting the tires up to optimal temperature.
Really front and center. There's been some very good articles on this. 47 degrees is what I see right now is being the temperature. Let's remember, folks, this race is at 1 a.m. New York time, 6 a.m. London time. I believe that's 10 p.m. Pacific time. They're going to do this at night, which they do at other races, but they don't do it up in the mountain desert of Las Vegas. There's a lot to talk about here, John, as we get to Toto Wolff, team principal, CEO of Mercedes. But John, the real issue here to me, and we're going to do a little bit more spanner and CIS bar. I was reading about the CIS bar.
Okay.
Folks, the side impact bar is very, very important for all these different cars.
I look forward to you flexing your knowledge on this.
Yeah, thank you.
All
This
right.
is more of an engineering discussion.
I think you're looking at it.
Maybe what we've had
I hope
before.
Toto's not running away from the camera. He joins us now, Toto Wolff, team principal and CEO of Mercedes-AMG Petronas Formula One. Toto, fantastic to catch up with you, sir. Let's just start with this new racetrack. We've spoken to a couple of people about it already. What kind of feedback, Toto, are you getting from the drivers on the simulator going into race weekend?
Yeah, first of all, good morning. Good morning to New York. We can also talk side impact structures if you wish, but I think you're gonna lose some of your audiences.
Yeah, I'm skilled at that.
Yeah, we can jump on a separate call, I'll tell you. So the drivers have been in the simulator, and I spoke to Lewis last week when we had a meeting in the factory, and he said the straight is so long and impressive, but we don't really know what to expect because, as you mentioned before, we're racing between 10 and 12 local time. Nevada nights, I've heard, can be pretty cold, and the only night racing experience that we have is Singapore and a little bit of the Middle East, but obviously never on a new track close to 5 degrees centigrade with Pirelli tires that have never experienced these kind of temperatures.
It does raise some questions as to why it's being hosted at this time of the year, at this time of night. Toto, how did that come about, and would you push for a change next season?
Well, obviously, Las Vegas stands for entertainment and show, and Liberty came up with the plan, which is great, to be honest. We've not raced in Las Vegas for a long time, certainly not in modern Formula One, and going there with this new format in the night, it's going to be spectacular. I think it's been said before, the track is brand new. That means the surface can be quite greasy or oily, because that's what asphalt does when it's new. We haven't raced in those temperatures, as I said before, but in any case, it's going to be a big spectacle. I don't know whether we will be sliding around or whether the track is going to be really grippy, but we shall find out in a few days.
We've been talking about qualifying and the prospect of maybe needing to do 2-3 laps to get tyres up to optimal temperature to put in that quickest lap. Toto, any thoughts on that at this point?
Yeah, we've had it in the past that sometimes you just needed to slowly warm up the tires, because if you push them too hard at the beginning, they grain, then you slide over the surface, the grip is never going to come. So bringing them in, driving them carefully, getting them up to temperature, and that could last a few laps, depending, and we're getting a little bit technical here, depending on how much you heat your rims and your brakes beforehand. And teams have various concepts. They either want to have the front tires pretty cool and long-lasting, or you heat them a lot, which gives you grip for a single lap for qualifying, but obviously harms them for the race.
It could be chaos, or it could be really exciting, one or the other. It goes to a conversation we've been having all season on this program, Toto, just how you balance pursuing commercial gains without compromising race quality. What do you make of the current balance of Formula One?
I think we had that balance, to cope with that balance for a long time. And I think why we love the sport so much is because it's honest. Entertainment follows sport. We're not designing regulations or content because we want to create scripted content with a certain outcome, with a certain degree of non-variability. We're doing this, we're launching ourselves. There's technical regulations, there's sporting regulations, and then off you go. Within a certain framework of cost cap, which is similar to the salary cap in some of the US leagues, everybody has the same starting point. And then we launch ourselves into this. So it's honest. The stopwatch never lies, and therefore the entertainments follow suit.
And yet we go through these periods of dominance. We saw it with Ferrari, late 90s, early 2000s. We saw it with you, Mercedes, for a long time as well, and now with Red Bull. So Lewis has said recently in the last couple of days that Red Bull is so far away, I think they're probably going to be very clear for the next couple of years. From your standpoint as team principal, is that a realistic assessment of the future, the next couple of seasons?
Well, we're giving it all to break a cycle. Like you said, we had 5 years of dominance of Ferrari, then we had a short spell of Red Bull, and then it was us 8 times in a row. And now it's the second constructor championship for Red Bull, or the third driver championship with a indeed very good driver. So we are, with all we have back in the factory and at the racetrack, we're trying to come up with a car and with an execution that is as good as it can be. And we have a next cycle of regulatory change in 2026, but we got to turn this around.
Well, for this race, and I think Toto Wolff, it's very clear. There's 3 races left: Las Vegas, and then back over to the Middle East, Qatar, and Abu Dhabi. Are you racing right now for next year?
Yes, we have done for quite some while. We're still fighting for the second championship in the constructor championship. We are second at the moment, and Ferrari behind us. So that's an interesting one. But deep down, second or third place doesn't matter. We got to, with all humility, fight for the front, and that's why many months ago already we've switched and we transitioned to a new car.
Toto, there's a phenomenal photo of 3 Austrians: Niki Lauda, Toto Wolff, and a guy named Schwarzenegger. It's a really, really cool photo. And to take what Arnold Schwarzenegger did, and all of our American audience removed from F1 understands the tie-in here. When you look at the showbiz of Formula One, the Netflix success of which you're a star, has Formula One gone to showbiz in 2023?
Obviously, there's a few Austrians of us that have gone beyond the country, and Schwarzenegger probably the biggest. And I was lucky enough to be very close friends with Niki. We traveled the world around in his function as chairman of the team, and there were very valuable lessons that I could learn. Did we go beyond the sport, too much entertainment? No, I don't think so. We're trying different formats with the sprint race weekends and or Las Vegas racing in the night. And if it needs calibration to provide a better show whilst staying true to our values of the honest sport, I think we got to try it. But the core product, the Grand Prix on Sunday, within the regulations, financial, technical, and sporting is always what Formula One has been all about.
Let's finish on the prospect of expansion, Toto. I believe you've been against the expansion of the grid. Do you think it's now ultimately inevitable?
I think the 10 teams that have been in the sport have been so for a long, long time. The smaller teams or midfield teams have gone through a lot of hardship a few years ago when COVID struck. But in any case, they fought for survival, and here we are with the cost cap kicking in. Most of the teams have turned into profitability and finally are in a sustainable way in continuing. But that is not a given. We are on a high at the moment, and therefore we got to respect what the FIA and the commercial rights holder are going to decide whether they want to have an additional team joining. And obviously, if we are being asked, we're saying as long as it's a creative for the show, as long as we provide a better entertainment, more income, why would any team be against it? But fundamentally, it's somebody else that decides.
And Toto, it's wonderful to catch up with you, sir, going into race weekend. Good luck to you and the team. I'm looking forward to watching the race over the weekend. Thank you for being with us. Toto Wolff there, team principal and CEO of Mercedes-AMG Petronas F1. Are we going? Are we making this happen?
$1,800
Did you look for
class.
flights?
Hotel prices are down, though. We were looking at
80%.
Bramo was checking
$5,000 a
this.
night. There's a Motel Cease that, it's on the way to Tehachapi.
Oh, is that what we're saying?
Yeah, it's just
What are the
over
odds
border.
of TK in a motel?
Motel 6.
Motel 6.
Motel 6. I think that's, I'm going to put the over-under at pretty much not happening.
I don't think that's happening, TK. I don't think that's happening at all. On this equity market in just a moment, Amy Wu-Silverman of RBC Capital Markets, and thank you to you all for joining us as we cover Formula One, TK, this season.
How they do?
Much more still to come. Much more still to come through the year.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Daybreak Europe, I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think the market needs conviction that the Fed is really done.
This is a Fed that really made a hash of things with the great transitory fiasco, and they can't afford to be wrong again.
We've always been in the higher for longer camp. We're normalizing at a healthier level, which is going to help set the foundation for more growth, more earnings, more upside for U.S. equities.
At least through the end of the year, we're looking at still a pretty robust economy. 2024 is really the bigger question.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market slightly negative on the S&P 500 after 2 weeks of gains on the S&P. Squeezed one out last week, TK. It is outlook season on Wall Street to kick off this week.
It is. The outlook's changed. We'll get to that in a moment. But huge news flow this week, including CPI and retail sales. It's not the snooze fest last week. It was. You wonder how the equity markets will react. Ed Yardeni's out front, the bull, and Dr. Yardeni framing out a stunning 5,400 by the end of next year. I believe my Amy Wu Silverman math says that's up 22%.
We'll get to Amy in just a moment, TK.
Yes.
I think this is actually an interesting week we've got in store here.
Yeah.
Got a lot of Fed speak, some really interesting data points, two really important ones, and I know you'll give us the calendar in just a moment, Lisa. On top of that, you've got this meeting between Xi and Biden just around the corner as well.
And you also have, of course, the potential government shutdown. But what I'm looking at right now is this divergence, and we've been hearing about this increasingly, between corporate America and Washington, D.C. Right now, Max Kettner was saying that there's a lot of bearishness. I don't see it. In all of the Goldilocks kind of reports that I'm looking at coming out, there's a lot of bullishness about corporate America. There was a lot of bearishness about the political sphere, especially given some of the budgetary concerns.
It could turn on a dime with the economic reports this week. I'm not predicting that, but it'll be. I can't fathom the equity markets if the data this week confirms a resilient consumer and a disinflationary trend.
If Morgan Stanley's right, if this is the promise, slowing growth and easing policy, I think a lot of people, Brahma, would take that into next year. Just slowing growth, gradual stuff, soft landing, and some nicely easing policy on top of that. I think a lot of people would take it.
It's just smooth and lovely and Goldilocks.
It always is until it's not.
But Goldman Sachs takes it a step further, which is disinflation and still rates staying high, but lean into risk because that's going to really do well. Because at the end of the day, we're never going to land. I mean, essentially, it's either a soft landing or no landing, and that's basically the Morgan Stanley versus Goldman Sachs
on the
divide.
board here on radio, we got a board up here, Fed funds rate, unemployment rate, change in real GDP, core inflation, and the huge distinction there is the unemployment rate, and that's the same distinction I failed at over the last, 14, 15, 18 months. The labor economy is going to slow.
Look, that's the standout note for me over the last week or so. Jan Hatzius, Goldman Sachs, really constructive into 2024. Disinflationary trends continue, Lisa. There's tailwinds to growth. If growth slows down, the Fed's in a position now where it can support growth. Just all the good stuff and more, even if things go wrong.
So is consensus now bullish? And this is really a key question heading into 2024 because every time we get a consensus, it's been wrong. Is the consensus now either a soft landing or no landing, but either way, things are going to hang in there. And even Morgan Stanley's bearish call of a base case of 4.3% unemployment is not exactly
when isn't
alarmed.
Consensus bullish?
Coming into this year, consensus was not bullish. People thought that we were going to get a recession. Maybe it would be mild.
The economists, sure, but there's always an equity strategist with somewhere to sell. And they're selling stocks, aren't they?
That's fair.
They have something to sell?
They do, Tom.
I didn't know that.
They do. We can talk more about that a little bit later. Maybe we'll have a secret chat and a commercial break.
Okay.
Equities shaped up as follows on the S&P 500. Futures look like this, negative by 0.1%, just a little bit softer. Yields a little bit lower, down a couple of basis points. We're down 2 basis points, Lisa. 463.40 on a US 10-year.
Maybe it really is immaculate disinflation. We get that eco data on Tuesday, CPI. On Wednesday, we get retail sales and PPI. Really interesting to see whether demand holds in and we get a disinflationary trend continuing to go down. But I'm looking at inflation expectations 5 to 10 years out and what that means. Yes, Tom.
Do we get an auction?
Just of T-bills.
Okay,
today.
just T-bills.
Do we have to keep doing this?
You can if you
Let's
want.
move on.
Continue
I actually
forward.
really,
It's great radio.
it's
We're
actually
auction-free.
really cringy. Let's talk about the geopolitical backdrop. China's Xi Jinping planning to meet with President Biden Wednesday in San Francisco. Are we expecting anything? We don't know. A lot of people are watching the dinner with executives that Biden pushed to be moved after his meeting with Xi Jinping. That was one of the big tussles about how to get this thing to actually happen. And on the domestic front, I think this is actually the most underplayed story of the week, the potential for a U.S. government shutdown on Friday. Not because I think that actually it really might matter over the long term, but the reaction in bond markets, in real yields, in when you strip out inflation, what the premium is that people are demanding for U.S. government debt, how much does that respond to more ongoing political dysfunction?
I looked up the outlooks for last year, looking at 12 months, just so you know.
Please.
Closed the year 3,800, right? The median outlook was about 4,100, 4,075 on the S&P, so just a touch of upside. Just enough, just a touch of upside. Even though people were looking for recession,
yes, exactly.
Equity strategists were still looking for a touch.
So now they're going to go nuts.
Of equity upside. We'll see. Let's have that conversation now. Amy Wu Silverman, head of derivative strategy over at RBC Capital Markets. Amy, good morning.
Good morning.
Can it continue? It's the only thing that matters right now. Can it continue? What would give you that signal that it can?
So I will tell you that it's interesting because we definitely get this signal from the options market. If you saw the beginning of the year, we had that low quality rally. If you saw the first half of kind of June, July, when that first NVIDIA earnings came out, the options sentiment tag along the way was also bullish. It was very clear that momentum was wanting to continue. I will say this time around, it is quite stratified. So on the IWM, you are seeing really bullish signals from options, but you're not seeing it across the board, and specifically, you're not seeing it in mega cap tech, right? And we all kind of know if tech goes, the market goes, and vice versa. You see it on Microsoft, but you don't see it on Apple. So again, it's very stratified. You're not getting that consensus saying we all have to tag along for the Santa rally.
So we're not just at the mercy of the bond market, is what I hear, because it seems to mean different things to different names in the same sector.
Yeah, I think people are getting a little bit more idiosyncratic. They've had this earnings season to kind of deep dive and look at these names. And of course, you know, when we got to that 5%, you know, we were going to trade off of it. But right now, you're seeing really different signals in different parts of the market. It's a little bit more factor driven. So it's more value versus growth, and it's more mega cap tech versus everything else. That's what's being priced into the derivatives market right now.
But just more broadly, is anyone actually expecting the market to go down?
No, and you know, the problem with that is there's really, you know, Tom's favorite word, the skew. There's really no skew in this market because, look, last year S&P drew down 20%, Lisa, and buying puts meant you actually drew down 21%. It's just failed to work. It's failed to perform, so no one's doing it. It's very boy who cried wolf. And this is with, you know, 2 wars going on. You didn't actually see that tail risk rise at all post October 7th. And to some people, that's a little concerning, too.
So at this point, would you say that overall people are kind of leaning into the index level? They're looking at trying to get some sort of alpha by just playing different names in some kind of way, but everyone is just basically trying to get in rather than get out.
I would say that's a more fair characterization. And the other thing is, look, when you have cash that's yielding 5%, the alternative to hedge is just not as attractive. It's sort of an existential question in our market right now. And when people lean in, it's actually far more to the upside. As I mentioned, IWM, we saw a historic rise last week in IWM call buying. Basically, it hit all-time highs after the move. And those are the kind of things you're seeing, people trying to get leaned in to the upside, but not on the downside.
So you mentioned skew. If you look at the other cross moments and simply the probability distribution, the guesstimate out into 2024, is it comfortable with derivatives signaling active or passive investment?
So I will tell you right now, the issue with our market, Tom, is it's become so short duration that I really feel like 6 to 12 months out, because folks also ask me about the election.
Have these one-day options mess things up?
Absolutely.
How have they met? This is really important. Think portfolio insurance, 1987.
Yeah.
How has the one-day parlor game messed up your world?
So here's the deal. S&P 500 volumes, you know, just trading in terms of option volumes, 45% is now 0 DTE. It's massive. So how much has gone short duration? And then, you know, I've been doing this for 20 years. People who used to trade 1-month options, they're trading 1-week options. Everything's gotten so short duration. So when people say, hey, what is the options market pricing 6 to 12 months out? I say the signal is not great. You can't use it the way you did, you know, 5 years ago because of this duration shrinkage we're getting.
So what are you looking at? Are you just basically avoiding it and looking to the MOVE index? Are you looking to bond market volatility to understand what the potential risk is in stocks?
We look at MOVE versus VIX. We look at a lot of the cross-asset volatilities versus the VIX. And then we also look at vol to give us signals. They're all very muted right now. The other dynamic that's going on, Lisa, is there's so much volatility selling. There's so much yield enhancement in this market that it's suppressing volatility, even on the equity level. But what we do is we can give a very accurate sense of what's happening 1 month and under. And the 1 month and under is telling you most people are still trying to do that upside grab in certain factor levels, but it's not cohesive across different parts of the market.
Just quickly, this volume going through 0 day to expiry, do you think it's risky? Do you think it's risky for overall financial markets? Is there a vulnerability associated with that we need to pay attention to? Because we get a lot of pushback against that. Would you push back against that?
I don't think it's as risky as it has been painted out to seem. And I will tell you that the SIBO itself has published data. They have data that essentially no one else can see that's saying it's pretty well balanced. You know, I would take that at face value. I don't have the data myself.
That's what Mandy Zhu told us.
Yeah, exactly. I know Mandy. And what I would say is there's this fear of a February 2018, right? There's a fear of a Volmageddon 2.0. The one thing I'd remind folks is that that was a 5% drawdown on the equity markets. It wasn't that big a deal to equity markets.
It felt like a big deal at the time.
It felt a big deal to the volatility markets.
I'm sure it did. Amy, it's good to see you. It's good to catch
you.
up. Amy Will Silverman there of RBC. It is the most wonderful time of the year. Do you want to sing it, Tom?
No.
It is the... No,
I
okay.
don't have it.
It's
Steve
Outlook
Terrell
season
doesn't have a...
on Wall Street. That's what this was all about.
Steve Terrell at the Carlisle the other night.
The crystal ball.
Yeah.
TK, looking out to...
It's looking really rosy.
Looking out to... Just look, there's a tint of rose in there,
it's
Bramo.
just really just glowing.
It's
with
curing
this
my...
You're embracing that.
Yeah, no, this is a derivative. It's curing my kurtosis, you know.
You're embracing that, Bramo.
I mean, I take it on face value. I wonder about people come out and they say, everyone's so bearish. Well, they got to kind of change that too now because everyone isn't so bearish. So at what point does people start worrying about the bullishness out there? We're not there. But, you know, the idea of consensus being wrong year after year is notable to me.
Anybody that lived at 87 is going, what's the odd derivative product right now that's messing up the market? And Amy Silverman was brilliant on this one-day short-term option malarkey that's going on.
She's fantastic. She's always brilliant.
I don't have
just
that
joining
in
us,
triple leverage.
Welcome to the program. Your S&P 500 negative here by 0.2%. Yields a little bit lower by a single basis point, 463.99 on the bond market a little bit later this morning. Next hour, actually, we'll catch up with Thomas Kennedy of JP Morgan Private Bank. Looking forward to that conversation. Fixed income, the sloppy bond auction of last week, and the downgrade of the outlook from Moody's on the US credit rating to negative. To negative, Lisa. Does it matter? That's an ongoing conversation. Is it justified? When you go through the justification for it, it's hard to argue against it, isn't it?
100%, which is possibly the reason why you've seen bond yields rise and stay stickier and higher in a longer way. What I find interesting is that it might matter for the bond market. Does it matter for equities? Because it's increasingly equities are getting really sick of bond market volatility. And as much as they look to that, I mean, that was sort of the end of last week was just exhaustion. Yeah. And stock market saying, you know, forget about you guys. You guys just keep bouncing around, figure it out. We're going to go invest in our companies and do our thing.
Equities rallying even with a 2-year north of 5% again, 5.06 this morning. In just a moment, we'll catch up with Anne-Marie down in Washington, D.C. We'll talk about some of these stories with her. Thank you for the feedback regarding our Formula One coverage. This note came in across the Bloomberg. Do you have a partnership with F1 that get you so many interviews, or is it because London traders aren't watching markets and spend more time on sport? Might have something, Tom, to do with the latter and not the former. Equities right now, negative 0.2% on the S&P 500. We are pulling back after 2 weeks of gains. There is tons to look forward to this week. Lots of Fed speak. If that bores you to death, lots of data. CPI just around the corner tomorrow morning, the day after retail sales in America, which I happen to think is actually a really, really important economic data point. After payrolls, after CPI, that's got to be like in there in top 3, TK, going into year end.
I agree. Retail sales, and arguably, could it be more important than CPI?
And then a big meeting between Biden and Xi on the West Coast in San Francisco, which is looking very clean, very tidy.
Oh, yeah.
Almost as beautiful as New York City.
Look at how nice it
looks. Good
looks.
morning.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
When it comes to managing the relationship, ties and communications between our two militaries are critical. The Chinese have basically severed those communication links. President Biden would like to reestablish them, and he will look to this summit as an opportunity to try to advance the ball on that.
There is a big get-together later this week on the West Coast between Biden and Xi. That was U.S. National Security Advisor Jake Sullivan speaking on CNN over the weekend. Live from New York City, welcome to the program. Equities look like this on the S&P 500, pulling back just 0.2%. Yields pulling back as well by a couple of basis points. The 10-year 463.40. The euro not doing much at all. Just a bit softer. Weaker euro there against the dollar. That currency pair pulling back by 0.09%. 106.76, Tom, on the euro against the dollar.
It's going to be interesting. I mean, Amory Horton is going out to San Francisco for these meetings.
They've cleaned it up
I mean,
for
the
her, Tom.
cuisine there, you know, getting through they're cleaning up and all
I've
that.
heard you can go into CVS and they haven't locked up the toothpaste.
Yeah, but
just for this visit. Just for this visit.
Seriously?
Just for this visit.
Wow.
But you know,
I'm joking. I've got no idea.
Darn it.
But that would be a real cleanup
that
effort,
would,
right?
That would be
If
really
you could
something
actually,
meaningful.
that is how you judge any city. When you go into CVS, is the toothpaste locked up or not? That's how you judge a city in America right now. Tom.
That is. Well, they're not doing that in the United Kingdom. But I would say in San Francisco, it's about the food. And Amory's going to be at Saigon Sandwich or Volcano Curry. And, you know, I think there's a real opportunity for the president to do a walkabout with Mr. Xi and, you know, see the cuisine of San Francisco and get it done right.
It is so sad that I was really genuinely excited.
Things are so much better. Crime's dropped so much.
That maybe we wouldn't have to lock up toothpaste and deodorant. That, to me, is one of the biggest barriers and frustrations when you realize you don't have something.
Without
You
doubt.
go in and you have to push a button and then wait for someone to come and unlock it, and then you feel vaguely guilty picking something out and judged.
To be fair, every country does this. Whenever you get a big foreign leader coming in, have you heard where the location will be for the G7 in Italy next summer?
Oh, no, just that we're going to be there. The cruise
Puglia.
ship you got is just great.
Middle of June, Borgo Ignazia. Okay, beautiful hotel, luxury resort. Giorgia Meloni, I was almost upset with her, the Italian Prime Minister, because I think there are certain areas of Puglia in the south of Italy that are really, really deprived and could use a lot of attention and a lot of money and a lot of investment. Go to that place. Help people invest in there. Get some business, some tourism going there in the middle of June. Go to the most luxurious hotel on the Adriatic coast, Itike in Puglia. I think that's a missed opportunity. I really do. That hotel will be sold out in June regardless of whether the delegates, the officials and statesmen and leaders from all over the place go or not.
And does anything get done, and will there be a statement out of this meeting in San Francisco?
So in some ways, it's nice they go to San Francisco and actually clean up the city. Because it
Let's see how long it lasts.
My God. And Anne-Marie's staff just emails in and goes, Anne-Marie's got a reservation at Lou's Cafe in San Francisco. Joining us now, our Bloomberg San Francisco restaurant correspondent, Anne-Marie Horton. It's not going to be lots of delicacies in San Francisco food. There's going to be serious conversation of these two presidents. What will be the lead item, Anne-Marie?
Well, Jake Sullivan said over the weekend, the highest priority really for the president has been to reestablish those military-to-military connections. Remember, we have not had a Lloyd Austin sitting down with his counterpart. There was a Chinese counterpart for the head of the defense, although he abruptly was removed from his post. We're still waiting for the next name. But Lloyd Austin has been trying to sit down with a defense leader from the Chinese government, and they've shrugged him off every single time. And this comes back to when Speaker Pelosi went to Taiwan last summer. So for the president, this does seem to be one of the highest priorities, getting back the military-to-military communications. Next on the list is going to be a slew of items. Iran will be discussed. What is going on in the Middle East? Obviously, the other power struggle in the world, Russia's invasion of Ukraine. In both these conflicts, the United States and China are on opposite ends. Then things like fentanyl coming into the United States. What is happening when it comes to their economic relationship? I mean, there's a number of items for these two individuals to discuss, and they haven't sat down since the G20 in Bali. So it's an important meeting.
What's wonderful about this, Anne-Marie, is the president assuming leaving, he'll be on United coming back to Dulles, Thursday morning. He gets back for a shutdown. What is the likelihood the president will fly back to Washington to shut down America?
Well, Terry Haynes of Pangea Policy says that it's a 30% likelihood now of a shutdown. What you're seeing from the House Speaker over the weekend is this laddered approach or two-step approach. Some parts of the government will be funded till January, and other parts will be funded till February. That's a nod to some members in his party to say, look, I'm not doing a full carte blanche, clean continuing resolution. I'm doing it in two approaches to give some impetus and some pressure to get these appropriation bills done. The fact of the matter is, though, it is a clean continuing resolution. He's keeping the government open, just in different tranches. So that's drawn a lot of ear from some very right members of his party, notably Chip Roy, a number of individuals who are saying this is not what we want to see. And it's also drawing ear from the White House, who is annoyed about this two-step approach, and also the fact that this continuing resolution does not contain the supplemental request the president has asked for Israel, Ukraine, Taiwan, and the southern border. But the fact of the matter is, we have not seen the Democratic leadership in Congress come out and tell Democrats how they should vote. So likely this has a path to passing in the House of Representatives. It doesn't have a poison pill, so it'll be hard for some Democrats to vote against this. And yeah, he's going to lose some hard right members, but I think most moderate and centrist Republicans who want to keep the government open will. The fact of the matter is, though, this is how Speaker McCarthy lost his job.
Yeah, and that's definitely hanging over current Speaker Johnson. I'm just wondering, in San Francisco, which will be very clean, we were just talking about that, is there going to be animosity between President Biden and some of the corporations in the United States that are having their own dinner with Xi Jinping, and they're very much different kinds of approach to diplomacy?
Well, I think the White House understands that America Inc.'s CEO is going to be the most important meeting for Xi Jinping. But Xi Jinping is making this visit to San Francisco, to California. On the sidelines of APAC is the CEO's APAC meeting. So, of course, he's going to want to sit down with chief executives. Sometimes what I think gets lost in mainstream U.S. media is how fragile China's economic recovery has been since the pandemic. Look at the property market. Look at youth unemployment. This summer, it was 20% until they stopped putting out the data. So Xi Jinping has some domestic issues he needs to deal with at home. And he wants to make sure that when you see what's going on between export controls and penalties and sanctions taking place via the United States on China, he wants to really bring in some more investment. And that is why he needs to sit down with chief executive officers. But obviously, the most important meeting will be with President Biden, because this will be a higher level, not just when it comes to the bedrock of relationship of economics, but a number of other issues as well.
Just quickly here, Anne-Marie, how low is the bar right now for anything to come of this meeting? I mean, that's basically what everyone's been telling us.
Well, I think the bar is the fact that these two individuals are meeting and sitting down is happening, and that bar will be cleared. And that's really what it was. The fact that they're meeting is a sigh of relief, honestly, for a lot of world leaders around the globe that do not want to see a tit-for-tat continuing fighting between Beijing and Washington. And they don't want to see this bifurcated economic system where they either have to side with the United States or side with China. So world leaders are breathing a sigh of relief that these two individuals are sitting down. Potentially, if they get the military-to-military communications back up and running in a normal cadence, that will be another win. But you're right, Lisa, the bar is very low.
MH, thank you. Dan in Washington on the meeting. Big meeting coming up a little bit later this week between Xi and Biden. No deliverables expected here, Bramo. so to speak. It's the jargon, isn't it? Deliverables.
That's good. It's like take
It sets the stage for maybe some further down the road, though. You have to start with a conversation, and this is the conversation we begin with.
And it's the first one since the whole drone getting shot down, the balloon fiasco and what happened with Tony Blinken, and then the potential slights at the table with President with Xi Jinping, and the potential risk there of the tit for tat rising. I do want to know, first of all, whether they're going to lock up the toothpaste, but then more importantly, what the corporations come out of it with, because they actually could come out with some deliverables, including Boeing jets.
Well, yeah. Well, I mean, the Boeing is a big $52 billion deliverable, which is great. But to me, the major deliverable here is just the pomp and circumstance of it. Ed Ludlow, thanks for watching this morning in San Francisco, Ed. And he says,
he's awake.
Good Mong Kok is where you get your best deliverable Chinese dim sum. Thank you, Ed Ludlow, for that wisdom. Chinese takeout in San Francisco.
All right.
It's good.
Good. All right.
You're not at the
You're
Four
done.
Seasons.
Okay.
Yeah.
Honestly, the stuff they'll banner for you. Honestly.
Ed Ludlow nailed
Okay.
that.
All right.
Just nailed that.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the program. Your equity market looks a little something like this across the S&P 500 and the Nasdaq. On the S&P, we're pulling back just 0.25% on the S&P 500. Nasdaq futures down by 0.27% over the previous 2 weeks on the S&P 500. 2 weeks of gains with a really strong finish to last week, even with this picture in the bond market, a 2-year back north of 5%. Your bond market right now, 2-year, 10-year, 30-year looks like this. Yields coming a couple of basis points. Tom, the 2-year still 5.0454% on a 2-year yield. The 10-year this morning down a couple of basis points. Let's call it 463.
I'm glad you caught that, John. I missed that. We're at a 505 on the 2-year yield, and that's part of the enthusiasm Friday.
And still had a strong finish in the equity market, even with that move.
Very good.
Should we look at the 30-year together, just after the sloppy bond auction we had last week? The 30-year at the moment shaping up as follows. Your yield was through 5%. It's back down to 475 and down another basis point, Lisa, this morning.
My favorite part of this is that this counts as not volatile. The fact that we didn't go up and down 50 basis points and only 25 basis points is actually a victory. And suddenly this is being viewed as stability that you can bank on, at least in the equity market.
The market? The equity market did this auction and then on
the auction did,
the stock market?
But I think that what we have gotten, and with all of our crystal balls that look beautiful, what we've gotten is, it's gorgeous. I think that people are looking at the unlikelihood that rates are going to go up much higher from where we are, and unlikelihood that we're going to get 10-year yields to 6%, like some people are projecting earlier in the year.
So this is what Stan Chart and Eric Robertson were talking about over the weekend. You can make the call, maybe dollars peaked, yields have peaked. Can you make the call that we're going a lot lower from where we are? Or are we going to consolidate? George Bory, I think, over at Wells, thinking we consolidate around these kind of levels.
It's a great question, and that's what I found most interesting about Morgan Stanley and Goldman Sachs. They agreed on a lot. They totally disagree on where rates go, whether it's going to be 3.175% or whatever, the 2.7, whatever, Morgan Stanley or the...
This is great, Grandma. Well memorized.
Have some more dim sum.
4.5%. It's Monday. It's been a long week.
To get to that yield call, they disagree on the unemployment rate. To me, that's the key distinction of those.
Jan Hansius is way more constructive on that stuff. Yeah, sure. Under surveillance this morning, let's get to it. The Israeli military pressing on with its offensive against Hamas, conducting raids in northern Gaza on the outskirts of the third largest refugee camp in the enclave. Senior Israeli and U.S. officials suggesting that talks on securing the release of some 240 Hamas-held hostages are intensifying, while Lisa, the U.S. conducts airstrikes in eastern Syria on targets linked to Iran over the weekend.
I've been reading obsessively about this, and the more I read, the less I know. I don't understand exactly what the conversations look like. The meeting in Riyadh with the Iranian head alongside the Saudi Arabia heads, this is unheard of in the past decade, right? We're looking at all sorts of new kinds of diplomacy, but I'm not really getting a clear read other than what you would expect in terms of some of the readouts. So again, it's just a lack of knowledge with a lot of misinformation piled in.
Yeah, what I want to know from Ethan Bronner and our Tel Aviv team is, how is Mr. Netanyahu doing? There was there was a great confusion over the weekend over one nation at war versus the domestic politics that the Prime Minister faces.
Under pressure domestically, Tom.
Yeah. To me, a real mystery into this week to see how Netanyahu gets to November, for that matter, gets to December.
Speaking of this week, looking ahead to a phenomenally busy week. US CPI data due tomorrow, along with earnings from Home Depot. Big week for retailers and retail sales as well, which come on Wednesday, by the way, alongside US PPI data. You get earnings from Target then. Then all eyes turn to President Biden's scheduled meeting with China's Xi Jinping at the APEC summit in San Francisco. On Thursday, more retailers, Walmart, Macy's, and Gap. And Friday night at midnight, is Congress's deadline, Lisa, to pass a funding bill in order to avoid a US government shutdown. We mentioned this in the last hour. This week, there's a lot on this schedule, on the calendar for this week.
And it's a fantastic litmus test for exactly what's moving the market the most. Is it the benchmark economy? Is it rates? Is it the fiscal backdrop in Washington, D.C., or is it earnings that continue to be pretty robust with retail sales and the consumer driving it all? It's an incredible litmus test across a slew of indicators.
Claudia Sahm, never more in the news right now with discussions of recession and that, and she's been brilliant on pushing against that. And the basic idea here is, what is the character of the American service sector economy? I'm going to guess we don't know. With all this technology going on, the haves here, the people going to Las Vegas to see Toto Wolff's team, all those people are prospering. Half of America's flat on their back in the meantime.
Claudia Salm, 8:30 Eastern Time. I believe she joins us in about an hour. Lisa insisted, here it is, the outlook from economists at Morgan Stanley and Goldman Sachs diverging on their forecast for the Federal Reserve. Morgan Stanley projecting the Fed to make deep rate cuts over the next 2 years as inflation cools. You can run us through the numbers, Brad. While Goldman keeping much more in line with the Fed's own forecast, which showed 2 quarter points cuts penciled in for next year. In the report, Morgan Stanley's Ellen Zent, a good friend of this program, saying, quote, "We maintain our view that the Fed will achieve a soft landing, but weakening growth will keep recession fears alive," Lisa, going into next year.
2.375 was their forecast.
Nice.
Anytime, I'm really glad I remembered that. But interesting to see the divergence between where they think rates go versus the Fed funds rate versus Goldman Sachs. The interesting thing is, when are Fed rate cuts a bad thing? When are they a good thing? And this, to me, is really going to be one of the key questions next year. Is it just sort of cosmetic cuts to sort of make it look nice based on the slowing economy? Or is this going to be a deep, profound cutting pace, which is what TD Securities came out with?
Make it super, super simple. There are some people on the street, Tom, who just want rate cuts, and it doesn't matter why they're cutting. I would sit here and say not all cuts are created equally. If it's because of a supply-side response, good news. If it's because demand has deteriorated to such an extent that you've got to cut interest rates, less good news. Pick your poison.
The poison I'm going to pick is with certitude. They're going to do it after the fact. They're going to be late to cut rates. They're by definition ex post. And then the series of rate cuts, if you believe in that, comes from the news flow and that immense pressure of being late by definition and then having to catch up.
And I think they want to be late, Tom. To your point, they want to be late this time because they want to be sure.
Can't
they want to
say
be
it enough.
absolutely sure that inflation is going back to target, based on what we heard from Neil Kashkari last week.
And wildly asymmetric discussion will be much for our Fed coverage here. Look for the Fed decides in the coming months here on Bloomberg Surveillance. Sonia Martin now on FX, on monetary policy, head of DZ Bank in Frankfurt, Germany. Sonia, thank you so much for joining. I love. I'm going to do this briefly because I know there's a million things going on in FX. But in Japan, with an ever weaker yen, you go out to pips, which folks conventionally is 4 decimal points out. It's not Gladys Knight and pips. It's every pip. And we're moving every pip higher on a weaker Japanese yen. What does that mean for those institutions in Japan? What's their level of panic at, say, 7 p.m. U.S. time?
I would say the level of panic is probably pretty high, but it's a difficult situation because, as you know, it's the Ministry of Finance that decides on FX intervention, not the Bank of Japan. The BOJ is merely the one executing intervention. And we had a situation last September, if you remember, where the MOF decided to intervene to stabilize the yen, but the BOJ remained really expansionary in terms of their monetary policy. And this is the problem they still have, right? I mean, the MOF is undoubtedly unhappy with the weakness of the currency. And, you know, with every pip that we move higher in dollar yen, this problem worsens. But at the same time, we still have the BOJ sticking to its ultra expansionary policy and still, you know, giving some very dovish tones. So it's tricky to intervene, and there's a high risk of failure.
I look at secondary pairs here like Australia as compared to Japanese yen. Which secondary pair do you study to get insight into weaker Japanese yen?
I think, to be honest, it really is mainly for us a question of looking at dollar yen and euro yen. I mean, obviously, if you look across the board, you will see the weakness of the yen, you know, widespread. It's widespread. You could look at the trade weighted index to get a bit more of a feel of how that's affecting the economy. But ultimately, I think, you know, trying to pick a level is always difficult because the BOJ and the MOF have in the past tried to avoid, you know, sort of creating this line in the sand that they could then be beholden to. So this is why, obviously, they didn't intervene at 145. So they've set it out a bit longer, but with every day that passes, the pressure mounts.
Sonia, a lot of what Japan is watching is the same thing that everyone on Wall Street is watching, which is the Fed and what the threshold is to cut rates, which could give them a pass to move away from yield curve control. Do you think that it's overly ambitious to view all Fed rate cuts next year as a good thing for risk assets?
Not necessarily. I think, you know, when you look at why the Fed is going to be cutting rates, I think you just discussed it before I came on the show. I mean, we're looking at a situation where growth is going to slow down, we believe, but it's not going to be, you know, we're not talking about a recession anymore. We're talking about a very soft landing. And what's going to happen is, as inflation declines, you know, real rates will rise, and this means the Fed has scope to cut rates. So I would very much view it as the Fed having that opportunity to cut rates. This is not, I think, a situation in which rates are being cut in response to very weak growth. So I don't think that rate cuts are necessarily negative for the market as a whole.
We've been talking about the different outlooks for 2024 coming out. We already spoke about Morgan Stanley and Goldman Sachs. TD Securities came out with this today, basically saying that they expect more rapid pace of rate cuts than markets do starting from mid next year. Do you agree with that?
We also have the Fed cutting rates as of the middle of next year. The particular problem that we're going to have next year is, of course, that the Fed will have a certain window to cut rates, and then the election is going to come. And they can't cut right before the election. So our best guess is they're going to start cutting in the summer, pre-election, you know, hot point, and then have to wait until after the election. So we're probably looking at 3 rate cuts next year. I don't know what the current consensus is, but it's probably in that vicinity, I'm guessing.
Sonia Martin, thanks for the update. Appreciate the outlook of DZ Bank looking ahead to 2024. We're calling these guesses, Tom, best guesses, guesstimates, crystal ball type stuff.
After this
next
year, after the last 18 months,
had
I think
5%
everything's
GDP
a
growth.
guesstimate.
There and thereabouts in the third quarter.
I don't know if you guys remember this, but it used to be routine rather to have a 3-year view and to have sensitivity analysis boxes with moving parts to it to show your certitude going out 2 years or 3 years on what-if basis. I haven't seen a report like that in ages.
I want to see a box that's just basically a dartboard. It's sort of, you know, you can interactive kind of forecast. You can throw your own dart. I mean, honestly, it's been a humbling experience for everybody, and nobody really understands the paradigm that we're moving into.
Lisa, we got some scenario analysis from Morgan Stanley, which, Tom, I think is what you're speaking to. You have a base case, you have a bull case and a bear case. This is the upshot, the upside from Morgan Stanley. This year's strength in consumption and investment extended to 24. GDP increases by a similar 2.5% 4Q. Payroll growth remains strong, and the unemployment rate continues to fall, reaching a low of 3.4%. Strong demand and inflation pressures force the Fed to hike an additional 100 basis points in 2024. That's not their base case, but at least recognizing there is an upside potential here, Bramo, that this continues.
If the labor market holds in, then a lot can happen that's very positive. If it does not, a lot can happen. I'm thinking housing, that's very much not.
Well, let's do this, John. Let's do it some data here, and I've got, I think, a really important.
You got things to say?
Yeah, I got a Dan Ives insight.
Is this
seriously?
a tease?
No, Dan Ives insight.
Okay, a tease.
Yeah, you know.
We can call it a tease.
Yeah, it's a tease.
Okay, I'll go through some numbers.
Ives is dressed like
let
that.
The suspense build, so to speak. If you're just joining us, something big is about to come from Tom, apparently. Equity futures negative by 0.2%. Yields are lower by a basis point, 10-year 463. Drum roll. Do you want a drum roll?
I don't need a drum roll. You know, thank you.
What's that? Okay,
the
great.
drum rolls.
Give us the insight.
You ever notice that Ives dresses better on CNBC than he does here? He shows
Is that your insight?
He shows up here like Lily Pulitzer.
Was this what we were waiting for, Tom?
No, I'm looking at this insight, which you can only get from the Bloomberg, 2.7 trillion market cap on Microsoft. Do we need to begin next year, in the following year, to begin to seriously gauge $4 trillion and $5 trillion market caps on some of these select Magnificent Seven? I don't think anyone's prepared for that, including a wise guy Super Bowl like Dan Ives.
So you've touched on something I think far more important. We've talked about things we got wrong this year. It wasn't just where the economy would go. It was where rates would be and where tech would be at the same time.
Yeah.
Microsoft's up 54% year to date.
Thank you. That's a better statistic.
It's up
you as usual,
54%.
Outshone
What's
me.
that at? 150 something.
Yeah, more than that, I think. Yeah.
Yeah,
And
nuts.
then the likes of Nvidia and just in their own world.
Total bonkers.
It's been amazing. In the next hour, 8:30, Claudia Sam, former Fed economist, is going to join us to talk about this labour market and what it could mean for Fed policy from New York City. Good morning.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is a Fed that really made a hash of things with the great transitory fiasco, and they can't afford to be wrong again, in the same cycle, in the same direction. That would look like they didn't learn from the first time round. Every couple of weeks, they're going to keep reminding us, until they stop, that, the inflation might come back and that they can't yet be sure, and that, we'll hike again if we have to.
That was Ian Shepperson, chief economist of Pantheon Macroeconomics, who thinks the Fed probably will cut rates next year, but they're just not going to talk about it yet, which is the tedious conversation we seem to be having every single day right now on this programme. Welcome, it's Monday. Equity futures look like this on the S&P. Keep it together, Bramo. Futures negative 0.2% on the S&P. Yields are lower by a couple of basis points, 463.40. Tons to look forward to this week. Should we go through the week ahead again?
Yeah.
Because it's actually a phenomenal week ahead, right?
Big week.
You've got this meeting between Biden and Xi. We can spend some time talking about that. But also you've got CPI tomorrow, retail sales on Wednesday. In between, you've got PPI. You get some Home Depot earnings. You'll get numbers as well from Walmart, Macy's, and Gap. And then on Friday, you've got this deadline for a government shutdown. I think one of those would be enough, Lisa, but you're getting it all at once this week.
It's a bonanza of potential instigators for market moves. And here's the question for me. What's going to be the biggest thing? Is it going to be fiscal? Is it going to be corporate? Or is it going to be monetary? And that's sort of, the economy. Is it going to be companies? Or is it going to be the dysfunction in Washington, D.C. that gets the most attention?
We haven't even touched on this. We're going to go British here in a moment, so let's do it. The Lord Cameron.
I'm actually worried.
Cameron is back in office.
As Foreign Secretary.
Yeah. It
Which
goes
is kind
back
of one
to
of
the
those
70s.
statesman-like roles that perhaps he'll enjoy.
What do you think? I mean, he was. I
my
clearly
thoughts on
remember John had put in an 18-hour day. I was sitting in Browns in Mayfair, and I'm watching the TV, and there's John doing it, and Cameron comes out in like John 32 seconds. He resigns. He says, "I got it wrong. I got Brexit wrong. Goodbye."
It's kind of bizarre. I mean, one of the biggest international events that's taken place for the United Kingdom in the last decade was Brexit. This was a man who was against it, lost the referendum, resigned as prime minister, and now he's back in the government, Tom, which is a bit of a turnaround, isn't it?
It's good.
Just in terms of being a statesman, though, respect on the international stage, I think you can make the argument he's still got it, can't you? And Rishi Sunak, the Prime Minister, who's under tons of pressure.
They're 20 points behind. In America, that's like huge.
Could probably use some stability.
Yeah. There's your British
whether David Cameron is your man for stability, I guess, is open to debate because there will be people on either side of that conversation.
Welcome to Bloomberg Surveillance. Lisa Bramowitz, Tom Keenan, the Lord Pharaoh. Right now, we're going to go to Queen Victoria Street, just near Mansion House in London. Our senior executive editor for energy and commodities, Will Kennedy, Grant Smith, writing it up today. OPEC argues against excessively negative sentiment on oil. Since the October low in the stock market in America, Brent crude's down 17%. How much is oil, this negative sentiment, how much is it playing into the guesstimates forward?
Well,
I think what you can say is that OPEC makes some reasonable points when it comes to the demand side of the picture. That demand does appear to be reasonably robust, that most of the oil traders that we speak to see strong demand this year from China, from Asia. They see that continuing to next year, despite concerns about the slowdown in the Chinese economy. And it's clear from the official selling prices that Saudi Arabia is confident in its selling its oil to Asia. So I think on that side of the equation, OPEC's probably on solid ground. Where perhaps they're on less solid ground is that supply also appears strong. You've got new oil coming on from South America, Guyana and Brazil. You've got a shale patch in the US that isn't growing as strongly as it once did, but is probably growing strongly. It's more strongly than people expected. And you've got Russian exports, which are looking quite lively again. And you put all that together, and the balances probably aren't that bad. You know, there's a lot of oil about.
Will, I'm fascinated. Maybe it's an unfair question to you, but you're so good at this, I'm going to try it. What's the perfect oil price for China? What's the optimal oil price for Xi as he travels to meet with Biden in San Francisco?
Well, I don't think China typically minds oil being too low. It does have a bit of a domestic industry, but it's not on a par with the US, for example. I think that the Chinese get uncomfortable with $100 oil. They can probably live with oil as it is now. They wouldn't want to see it higher. I think for consumers today, 70 to 90 is okay. Anything above 90 probably makes them a little bit more anxious about inflation.
But, Will, haven't they been stockpiling crude, cheap crude from Iran, from Russia for the past year? Don't they have massive stockpiles that actually will mean that they won't actually have to buy all that much next year?
Well, we do think that they have been adding to their stockpiles, both privately and state inventories. But this is the world's biggest importer of oil, and their demand keeps growing every year. So they're going to want to have the same margin of stockpiles, which means bigger stockpiles each year. What's certainly true, Lisa, is that the situation with Iran and the situation with Russia has given the ability, as the main buyer of crude from those countries, a country that many places in the world won't buy from, has given the chance to buy a lot of oil at discounted prices. And I think it's certainly true to say that Iran's growth in supply has been one of the most important factors in the oil market this year, and China has taken advantage of that, but we won't see similar growth in Iranian crude next year.
How much does that really pit Xi Jinping against President Biden when it comes to their meeting on Wednesday? The idea that Iran not being part of the Western world and OPEC Plus, as well as Russia also being an outcast, has benefited China tremendously from an oil purchase price standpoint.
But I think that the US, at least in private, would acknowledge that it's benefited them. When we think about the sanctions regimes, what's clear is that the oil has kept flowing, and I suspect Washington wanted to keep the oil flowing. And the last thing that the US is going to want into next year is a spike in oil prices. And if that means that China buys Iranian oil, if that means China buys Russian oil, I think the US is probably okay for that. One interesting thing to note, after events in Israel at the beginning of October, a lot of people expected the US to clamp down on Iranian oil exports because of their links with Hamas. Now, that hasn't happened, and I think that's probably one of the reasons why some of the bite has gone out of the oil price, why we've seen this fall off in prices, is because the US has shown, so far at least, little inclination to clamp down on the exports of oil from from Iran rather. And so that oil continues to flow. So I think China and the US is broadly aligned on the oil market. They're the two biggest consumers of oil. They both have inflation concerns, both have domestic constituencies. I think it's one area where they could probably reach a fair amount of agreement.
What about the rest of the Pacific Rim? I've always studied Indonesia as sort of a hugely ambiguous oil export, oil import as well. As we have this meeting in San Francisco, how will the Pacific Rim watch it in terms of energy?
Well, I think they're all pretty much in the same place. The big importers outside China are India and Japan, Korea and Indonesia. It stays as an oil exporter, long, long gone, Tom. It's now a big oil importer, despite having a sizable domestic industry to some extent, but its demand is just far outstripping that. They all rely on energy imports. They all rely on the Middle East to supply the bulk of those imports, and I think that they will agree with the Chinese that they would like oil prices to be relatively subdued, and they can't afford to see, given the fragility in their economies, oil go far above $100 a barrel.
This is not the move in crude we expected after the tragic events of early October, that terrorist attack on Israel, down something like 11% on crude since then. Will, thank you, sir. Will Kennedy of Bloomberg on the latest. That move in crude, Lisa, just totally unexpected. That second week of October, we were talking still about triple-digit crude, and here we are in the low 80s on Brent and in the 70s on WTI.
Why? I don't have a clear answer on why. Is it because of a lack of demand, or is it because of maybe the fact that the U.S. is producing a record amount of oil, or is this something else? I mean, honestly, is this just speculation, as Saudi Arabia came out and said?
I was weaned on this off of the Deutsche Bank Excel spreadsheets of Adam Szymanski, Paul Sankey, and team. And the answer is to your really important question on why what's called Marshallian macroeconomics, the supply and demand dynamics around the equilibrium point of oil is like nothing else in the world. It's teens, weens, micro, small, and as Will Kennedy nailed to us moments ago, yeah, it's about weak demand, but also at the same time, supply came on, as he mentions, Iran, and that's where you get the shocks. Right now, you got to believe it's a partial differential of both. I'm going to go with it's about weak demand.
So we framed this massive week ahead. I'm not sure what's more important, but I'll tell you what I'm interested in, the retailers. We've started to see jobless claims start to climb, just start to push out a little bit higher.
I think you're right on
Unemployment start to climb a little bit higher. What are the retailers seeing in their business every single day going into year end? And we've got retail sales together anyway, so that's kind of a feature for me, Tom.
Home Depot, see, they need to hire some more people. 471,600 work at the Orange Box.
That's in Walmart. Yeah. We're talking serious numbers. Coming up shortly, Thomas Kennedy of JP Morgan Private Bank on fixed income. Your bond market, stable, quiet this morning.
It's the Kennedy Show.
For once, the 10-year down just a single basis point. Your yield, 4.64.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger. But obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No. This is the nature of capitalism. Get over it.
I think actually this disinflation is pretty deeply embedded now.
Take the cash, but be ready to lean into equities. Get your shopping list ready to rebalance over the first half, maybe the first quarter of 2024.
There's certainly no reason not to own growth.
People do expect some deceleration and potentially bigger one than is currently priced in.
I don't think we're done with the volatility, Lisa. I think it's here to stay for a while.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A busy week ahead on radio and television. We'll bring it all to you. CPI, retail sales, a presidential meeting in San Francisco with China. And John, to have the Bramo cam on as we launch from the 7 a.m. hour over to 8 o'clock. It's a New York City tradition. Bramo pricing Christmas trees.
Bramo is pricing Christmas trees. Apparently they've gone up in price.
She is shocked.
Lisa reckons they've doubled. They've doubled.
They've doubled. And this is the cumulative inflation, which we talked about last week. And I'm sorry, it's the underpinning to this CPI report. We're going to go month over month, year over year. Our entire radio and TV audience is saying baloney.
They don't care.
It's the Bramo Christmas price.
It's 2019 versus now. That's what they care. The baseline is pre-pandemic to now.
I agree.
It's not month on month. Yeah. It's not annualized over the last 3 months. It's not year over year. It is 2019 versus now. And Thomas, a 1-2 punch this week. So retail sales on Wednesday, CPI on Tuesday, and I'm with you. That's my focus too. How much more sensitive is this consumer becoming? What do you see in the retail earnings this week?
Team coverage, our Bloomberg Christmas correspondent, Lisa Abramowitz,
Here we go.
joining us. What did you observe at Whole Paycheck?
Okay, look. I love this time of year because I love the smell of the pine trees. I love when they go up, and I always pass them, and I like walking through this corridors of trees. And it was $69 at the local Whole Foods, or Whole Paycheck as you call it. A couple of years ago, it was $40. And then, a year earlier, $35. You just see it in a new way that you hadn't seen it before.
And I'm going to go to the headline of the weekend in terms of outlooks. Always leading is Dr. Ed Yardeni with decades of experience. He rocket launches up 22% on his SPX call for next year. And this is the two Americas, John, that we've got that Lisa identifies. We have two Americas prospering, worried about the stock market, worried about the price of the trip to Paris, and there's another America flat on her back.
And that's the America that showed up in the consumer sentiment numbers out of you, Mitch, on Friday. Yeah. Consumer sentiment down, inflation expectations.
Well, that was a shock. Was it 3.2%?
Those 600 people that took that phone call moved the dial. I joke. But ultimately, I think that's the broader story in this country right now. That's reflected also in the polls that you see at the moment with regards to this White House and President Biden and the job they're doing with this economy.
Lisa, I was stunned by the moonshot of the market closing on Friday. What did bonds do in particular? I saw one chart, I think Goldman Sachs, of BBB spreads coming into new tights. But what did your world do given the melt-up that we've seen in 22 stocks out there?
In the outlooks for next year, how many people are saying that they're overweight investment-grade credit? And actually, if you want to get really excited, go a little bit into high yield. You see spreads contracting because what this is immaculate disinflation, a slowdown, cuts to the Fed funds rate that are just generally going to be positive for the credit sphere.
I'm looking at the real yield. I haven't quoted it yet today, John. 2.32%, Midland between that peak angst of 2.50%. Down we came. We came back a little bit in the 10-year real yield today.
Equities look like this if you are just joining us. We're pulling back by 0.2%, just a bit softer after 2 weeks of gains on the S&P 500. Yield's not doing much. Let's call it down a basis point on a 10-year, 464.39. Bramo, you can get like these pine needle candles if you'd like one. I'll get you one for Christmas. All right?
Well, I actually don't like the shedding.
No, but you can get a candle.
Yeah,
that
but
just
candle
smells
just like smells like the pine. But is it authentic or is it like cloying?
The scent of the season.
Like the cinnamon cloyingness, I can't take
an
that.
expensive one, all right? The scent of the season.
Oh, that's
right?
so sweet. Okay.
We'll hook Bramo up.
That's
Guys,
all right?
you don't have to worry about the scent when you got Vet Bill and Kennel Fee
Eating
over
up the
there.
tree.
It's something to
Adding their
see.
own scent.
What we do here is we have smart guests like Will Kennedy just joining us at Queen Victoria Street in London on oil, and now joining us his compatriot in Irish crime, Thomas Kennedy, joins as Chief Investment Strategist at JP Morgan. One Kennedy to another, and you linked it when you sat down and you looked at Will Kennedy's world and says when the price of oil moves, you see in Chase's charge card juggernaut reaction. What do you observe as oil comes down?
Yeah, we saw a change in the way the consumer was reacting to higher oil prices around August, September area in our Chase credit card data. Remember, we're banking about 20% of America, and what we saw there was...
A nice plug, you nailed that early on.
When gasoline prices rose, you actually saw discretionary spending go down. Now, Tom, you might be saying, well, of course you're going to see that, right? Prior to August and September, in the post-COVID era, we did not see that relationship. It suggests the excess savings in America might actually be depleting after how many quarters of negotiating on it.
Right.
And then when we really dig into the accounts of these folks, and we do it in an anonymous fashion, about half of America looks like they're out of excess savings.
If you're missing words up, it's okay. You're sitting on the side of the table where we do that routinely. I'm looking, Tom Kennedy, at the polarity between Morgan Stanley and Goldman Sachs today. You need the leadership of Bruce Castle and Michael Ferroli to give you an economic backdrop. What's your economic backdrop that forms your outlook call this year?
Yeah, we're expecting a growth slowdown pretty much like the rest of Wall Street at this point. And it is relatively simple and intuitive. You have the cost of capital above expected revenue in this economy. And if you think about America as one big business, it's very odd to see the cost of capital to be above expected GDP. It should force investors to say, maybe I'll just save instead of borrow money and invest in my business. We've seen this 4 or 5 times in the last 40 years. Just about every time you see a growth slowdown, Tom. So we should expect that to happen. The question becomes, what's the scenarios where it doesn't happen? And in those scenarios, you have one where either the consumer is much more resilient and they have access to borrowing and you're going to see growth come higher, or something breaks in the meantime. Those are pretty dynamic and polarizing outcomes in the future.
Everything you said up until then, though, said by the 10-year, go along the curve, lock in some of this yield. Is that right?
Yeah, I think it has to be. John, you have, at this point, a municipal bond that is giving you equity-like yields, and for the first time in 20 years, it is actually competing with the earnings yield on the S&P 500. For my clients that are gathering wealth for generations, I can show them something that has near zero default risk, and you can get equity-like yields. Is there risk to that? Of course there is, but that's a dynamic that they haven't seen in 2 decades, and now I can start to reposition some of their portfolio.
And they say, Thomas, I'm nervous. I'm seeing yields all over the place. Are they reluctant to buy? Even at these rates, even after you tell that story? Is there a reluctance still to buy it?
In our data for the last 12 months, this has been the trade that people have been excited about and can get invested in. That doesn't mean it's not without angst. When we saw a 5-year tax-free yield show up 2 weeks ago, that dynamic changed. 5% tax-free. For people in New York City where we're sitting, guys, you got to buy a taxable bond above 10% to get an equal return. So the behavioral experience for them did change there. I think as a market prognosticator makes you say, well, how high can rates really go before we're going to see that crowding out effect of high yields?
One of the mysteries of this year has been what the main driving force in yields has been. Is it the economy? Is it inflation?
Yeah.
Is it the politics or the fiscal backdrop? This is going to be a really interesting test. What do you think is going to be most important with respect to market volatility of all the things that are going to happen this week?
The Fed, expected outlook for the Fed. You can explain more than 3/4 of all the movement in rates just from those two things, where the Fed is and where you expect them to be in a year's time. In the last couple of months, you have seen, I would call it supply of treasuries become a little bit more of a factor, but not dominant at this point, Lisa. So as we look ahead, what's going to matter? The slowdown. How big of a slowdown is it? And importantly, what will the Fed's reaction function be?
You said that half of America is pretty much out of savings based on your data.
Yeah.
which half, right? I mean, is this the half that has been spending more aggressively and will continue to if they had the money? Or is this a half that is particular in the economy, right? I mean, we're talking about the two Americas. We've got a lot of Americas, and they're moving at different speeds.
Yeah. The two Americas theme really resonates for me, but the folks that are out of excess savings are the bottom half of America, and those are traditionally the ones that don't have excess savings. So now they have a decision to make. They can either slow consumption or try to turn to their credit card at a time when credit card rates are historically punitive, even when you normalize them for where interest rates are or base rates from the Fed. So I think the slowdown metrics make sense when your highest marginal propensity to consume folks are running out of their excess savings.
Really sharp article this weekend of the millions of Americans. They don't own Apple, they don't own NVIDIA, Microsoft. They've missed the boat and they got a 201k. They walk into JP Morgan Chase this morning with a disastrous portfolio. They're miserable. How do you approach the active versus passive retirement debate?
I think at this point in the cycle, Tom, active is going to make the most sense. In that, when you're looking at a passive allocation, even to the equity market, the haves and have-nots are there. On the one hand, you have, say, tech in the equity market that has gone through its optimization of its balance sheet. Layoffs in the tech sector have been big in the last 12 months. CapEx is now getting turned back on around AI, and the monetization phase is not going to be that long. Microsoft, as an example, 3% of their revenues are coming from AI already. Meanwhile, you move to small and mid caps, and these are the most interest rate sensitive sectors, and they have debt to EBITDA 2 to 5 times. They are going to feel this pain more than big tech. So in the equity market, as an example, active management, I think, makes sense. As a headline, early cycles when you rotate back to more passive ideas.
And that's not where we are right now, Tom, in the minds of many. Late cycle is where people think we are right now.
I think it's a muddle, and I'm really fascinated by the outlooks. I mean, Tom Kennedy's going to put together a 34-page outlook. I have a rule. I read the first
Hey, Tom, it must drive you nuts.
Pages.
This time of the year where it's difficult to sort of get beyond next week, to put something out for the next 12 months, how hard is that?
I think it's difficult when you're trying to do it at the end of a cycle. The Fed has just done the most aggressive rate hiking cycle we've seen. And where are you? Are you in the muddle through? Are you in the late cycle? Are you in the end cycle? That's the hardest part. But to be able to turn to your client and say to them, I can show you equity-like yields in fixed income, it's a way to buy some time and get some good yield in a portfolio.
Pro tip, more charts. That's the answer.
You just fill it with charts.
Pro tip. David Malpass at Bear Stearns years ago. When in doubt, add a chart.
I saw that from David Costin over at Goldman this morning. I was going through his outlook. It was just full of charts and tables. Thomas, this was great. It's good to see you. Tom Kennedy there of JP Morgan Private Bank, looking to add a little bit of yield, lock in that yield at the longer end of the yield curve. If you're just joining us, welcome to the program. Your S&P 500 shaping up as follows. We are negative here by 0.2%. Yields are a little bit lower, but let's call it a basis point, 464.39. No drama this morning. Maybe the drama is going to build through the week. CPI coming tomorrow. Retail sales data on Wednesday. PPI data as well. Retailers reporting earnings. Tons. Walmart, Home Depot. It's that time of the year, Tom, where we get those retailers going into year end.
They're always important, but combined with the economic data today, this is this weak demand theory. And I mean, I have a guesstimate. I'm completely unqualified to guess about Home Depot or that, but you know, they've been resilient over the decades, but now what? You know, after the pandemic, it's a mystery.
I cannot wait till the Walmart earnings call. I mean, to me, this will be one of the greatest litmus tests of the American consumer. If you think about it, when you walk in, do you get the Nerf gun for the kid that just happens to be there that they ask for, or do you just keep on walking by and stick with laundry detergent? I mean, this is sort of the questions that they see in a collective way, people all making.
Is that what they won this year, the Nerf gun?
They have one that's so irritating.
They want a new one.
They run around the house shooting each other with it. I'm screaming at them, please stop it. We just are digressing a lot.
I sense this was personal. I sense this was personal.
No one with the grandchildren visiting would get the most expensive kitchen.
I went past TK's terminal earlier.
I saw this too.
On the
It's
Bloomberg.
ridiculous.
He likes to play up, you know, it's got charts and bright flashy lights.
Differential
He was on Amazon this morning. He was on Amazon this morning buying a mini kitchen.
And I got the little baby. They're like Cuisinart, but they're Italian from the mountains.
Nice
dishes and the fake fruit and
Do you know
all
what you
that.
once got me for Christmas? A plastic pink tea set from Amazon.
I don't even know what to make
for children.
of that.
Yeah, it was like to get our tea or
British?
whatever. It's British. You had tea.
You have tea.
No one knew how to
TK's
get him
humour,
tea.
I don't know. I don't know. In the next hour on Bloomberg TV, Peter Cheer of Academy Securities is going to weigh in on the bond market. Cameron Dawson, Tony DeSpirito, all of that and more. This is Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This year's been more of a pivot to some of the wide body orders. So we saw a strong narrow body order. No doubt the world's on fire in terms of travel's back. It's a resilient industry, and remember, it's an industry still recovering. We think the resilience of this long-term demand is there, and that's explaining this need for airlines to get ahead and get their order book in place.
Stan Deal, Chief Executive Officer of Boeing Commercial Airplanes. We talked about this before. Big order today, $52 billion at the Dubai Air Show. Really interesting, and it talks about the expansion of international travel. This is not the Dubai we've all landed at any number of times, but moving towards Abu Dhabi, they're building an entire new airport there where they really have two international efforts. Lisa Bramwitz and Tom King, John Farrell preparing out to 9 a.m. as well. Claudia Sam will be with us here in a bit. Really looking forward to the discussion on the American economy. Guy Johnson is expert at the development of jets, the crafts that we fly every day. And he knows that Christian Scherer bleeds Airbus. Scherer grew up in Toulouse, France. He's been part of Airbus way back for many years, and he is now the CCO of the great European airplane builder. Guy Johnson in Dubai. Guy, good morning.
Good morning, Tom Keane, or good evening. The sun's setting on day one of the Dubai Air Show, and as you say, it has been a big one. We've seen some significant orders, some promise of even more still to come. And as you say, the wide-body market feels like it is back. Over the last few years, this has been all about narrow bodies. The recovery out of the pandemic driven by the narrow bodies. Now it's the big workhorses of the sky. Their time to shine. Let's talk to Christian Scherer, as you say, the Chief Commercial Officer at Airbus. If you want to know what's happening in this industry, he is the guy to talk to. Christian, nice to see you. Thanks for making some time for us. Look, the world at the moment feels like we've got a lot of geopolitical tension. We've got a lot of uncertainty. We've got a lot of economic uncertainty as well. Rates have been jacked up. Economies are slowing down. Yet it doesn't feel like it at this show. Huge orders across the piece in terms of what we're seeing from airlines from around the world. Why the disconnect?
I wouldn't say it's a disconnect. You know, an order at an air show is, I wouldn't say anecdotal, but it's being very much highlighted because it's an air show. You will have seen that this year alone there have been lots of orders, in particular with us at Airbus, well before the air show, during the air show, there'll be orders after the air show. So it isn't like an incredible peak all of a sudden. It's part of a phenomenon. The air show is an event.
It's been building for a while, though. This is a kind of moment in time when you can take stock. As you say, like you're about to sign a very large order with Turkish Airlines, a huge order. A lot of narrow bodies in there, but a lot of wide bodies as well. This feels like a moment in time just to reflect on what is happening. And it feels like demand from the customer is still very strong. Demand within the industry is very strong. They've watched what happens with the narrow bodies and they've sold out. Now these guys want to make sure that they've got their slots. What is driving this demand? What gives the industry this confidence?
Probably the fact, Guy, that we're seemingly in an undersupply situation again. So there's a lot of jockeying for delivery positions. You don't want to miss the train. Just a few years ago, in the midst of the pandemic, remember, we manufacturers were asked to slash our production by roughly 50%. So it takes time. There's a lot of industrial inertia to rebuild an industrial system that's capable of producing large numbers of wide-body airplanes. And so they don't come in large numbers. So you don't want to miss the train.
You study the numbers very carefully. If I look at what is happening with discretionary spend at the moment, I listen to LVMH or Richemont or Diageo, they're talking about that sort of high-end discretionary spend beginning to roll over. Do you think that happens in aviation, or do you think the lesson from the pandemic is, you know what, I won't have the cognac, I won't have the Cartier watch, but I will have the airfare?
I think the latter is true. I think an air trip is no longer a luxury per se. It is part of discretionary consumer spending. It's probably
at the top of the list?
I would think that the recent behavior that we've seen, beyond the obvious phenomenon of pent-up demand coming loose after the pandemic, I believe that the consumer will tend to go enjoy himself, herself, visit friends, family, before they buy an expensive watch.
In terms of kind of what happens next, do you see this demand being sustainable? You talk about the fact that the air show shouldn't just be how we perceive what's going on. You see this as being a sustainable story now. You think wide-body demand is back. Where in the cycle do you think we are?
I'm not sure we can talk about cycles as much as we used to anymore. So I do believe fundamentally it's sustainable. Our studies are telling us that we will see continued growth in air travel, including in wide-body air travel. A little bit less perhaps than before the pandemic, or irrespective of the pandemic, because of the inflationary pressures, increases in fuel prices, etc., etc. You mentioned it. So but we do see sustained demand, including on intercontinental travel, and we do see on the large aircraft, where fuel burn in particular and technology plays the biggest part, increased demand to replace old airplanes. So there's more replacement in the years ahead than there was before.
You talk about inflation. What are you building into these contracts? You're selling airplanes 5-10 years down the road. Inflation is running hot right now. How are you building that into your contracts? How much are you building into that contract? How important, when you sign a contract, is that escalation clause?
That's a really good question, and that is a subject of finding the right balance of how you share that risk of inflation with the customer, the airline, that is making a purchase decision many years in advance. Typically, Guy, what we do is we index our pricing on indices of material costs and labor costs. Those are U.S. industries. Those are the most mature indices that exist in this industry. So we index that, and then if it's a discussion, depending on how far out the airplane is being ordered for, that's a discussion of how we share that risk, that inflationary risk with our customer.
Are you going to be able to build all these airplanes? I spoke to Guillaume a few days ago, the CEO. He was talking to me about going from 9 to 10 on the 350 program. If this demand continues, do you have to go 10 to 11, 11 to 12, 12 to 13? And how hard is that?
Well, one step at a time. Remember, we were at a rate 10 before the pandemic. We slashed it down. Now we're ramping back up to 10. It's not a trivial thing. Airbus is not necessarily the limiting factor here. It's a huge supply chain that we're pulling with us, and that's the pacing item. Is it conceptually possible that we go further? Yes. In fact, the ever-optimistic commercial man in me will say, yes, most probably we will. But that is not for today. We have objective 10 per month in our site. That's what we're going to do. And our programs are running very much on time.
One final quick question. It's come up a lot today in the conversations that I've been having. The Rolls-Royce new CEO, Tufan, appears to be running the business in a slightly different way. He can clearly add up. He clearly wants to make some money. And that is resetting the relationships within the industry. They are sole supplier on the A350. As that relationship changes, how does the relationship between Airbus and Rolls-Royce change? Airbus and Emirates change? How does it change the nature of the relationship between supplier, customer, and ultimate customer?
Well, I'd say two things. The first one, the most important, is we're really, really happy with the Rolls-Royce engine on the A350 program and on the A330 as well. But on the A350 program in particular, the XWB engine, I will dare say, is by far the best engine in the sky today. In reliability, in fuel burn, in durability, it's a wonderful engine. So that's point one. Point two, yes, there is a resetting of pricing in the engine business. The fuel burn, the engine guys have developed fabulous machines to lower the fuel burn. That comes at the expense, at some expense on the maintenance side, because these engines consume parts quicker. They consume less fuel, more parts. And that reset is what's happening in the industry, in the engine industry at large, and Rolls-Royce is no exception.
It's been great to see you. Thank you very much indeed, Christian. Thanks for taking us, taking the time and hosting us here at Airbus. Tom Keane from the Dubai Air Show. The sun is setting here. Back to you.
Guy Johnson, thank you so much. Always interesting. Much more to talk about. I need to tell you the schedule tomorrow at 8:30 a.m. A report on inflation coming up today at 8:30. Claudia Sam. A beautiful day in New York.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance. Good morning, everyone. On a Monday, an eventful week coming up. We'll get to the economic data in a moment. The data right now that you need: equities, bonds, currencies, commodities, futures -7. I'd say a little bit better tape than 2 hours ago. The VIX crescendos high to a fear level of 15.01. Amy Wu Silverman, Lisa, was brilliant earlier on the oddities as measured by things like the VIX.
Yeah, and that basically, if you look under the hood, people are trying to parse. It's not all big tech or not into big tech. It's Microsoft versus Apple. It's really trying to understand the nuances of a market that people are not willing to bet against yet again.
Turn to the bond market. I missed this on Friday. 5.05% of the 2-year yield. I mean, we really vaulted back up to a yield that describes maybe a Fed meeting to come. There's one in December.
And we're also going to get a bunch, or if you want to get a gauge of that, just check out the Christmas trees. But I am looking right now at the expectation for CPI at about 24 hours time. We'll get that. We also get at 11 a.m. We haven't mentioned this because it's more peripheral. The New York Fed's 1-year inflation expectations. Do any of these sort of smaller indicators really move the needle in a more material way if they prove to be some sort of outlier?
I got lectured once, Lisa, by one Michael McKee, our Bloomberg International Economics and Policy correspondent here on the secondary and tertiary data. I believe it was the Empire statistic of Buffalo, New York. Michael McKee, to Lisa's smart question, do these secondary inflation guesses, are they something we should pay attention to?
It fits in with what the chair and the rest of the Fed say about the weight of all of the evidence. They are watching inflation expectations because inflation expectations are a bedrock of their inflation dynamics system. They feel that if they become unmoored, as it were, that suggests inflation ahead. So they're watching those. There's some concern about what's happened with Michigan lately. We saw another big jump on Friday in the Michigan inflation expectations numbers.
Just quickly, did people actually care? I was actually shocked that people seemed to have a John and Tom response to it, which was they had the highest inflation expectation for 5 to 10 years, going back years, and people just kind of shrugged it off as, they just surveyed 600 people.
I think people aren't really putting a lot of credence in Michigan, and I'm not sure why, but there seems to be some oddities in the way people are responding to surveys right now. We see the same on the political side. But the thing about the Michigan numbers is they're up, but are they really telling us, you know, where people think inflation is going to be at a time when gasoline prices are just falling rapidly, and Americans tend to equate gasoline prices with where they think inflation is going to go.
You said people are responding to surveys in weird ways. Can you elaborate?
Well, a lot of people have been asking about what's going on with the fact that Joe Biden can't catch a break in these surveys. And inflation's going down, and growth is high, and unemployment is low. And there seems to be a feeling among professional pollsters that what we're seeing is a protest vote, in other words. People are saying that they're answering a poll because they know it doesn't matter right now. And they're answering a poll and saying, I don't like things the way they are right now. Inflation is still too high. We're not seeing inflation come down. And that won't necessarily be how they feel a year from now.
Right.
And anybody who has worked with statistics and polling know that you don't put any weight on what people are saying a year ahead of time. Fills time on TV networks and takes up space in newspapers, but doesn't really mean anything. And so you're getting this weird public vox populi that's in opposition to what logic would tell you. And so that's why we say there's some weird stuff out there. It's same with the economics. Everybody seems to be saying my life is great, but the economy overall is bad, and that doesn't compute.
Mike, we talked to Lisa Bramowitz, Bloomberg Christmas correspondent, here earlier about the price of Christmas trees, a moonshot at Whole Foods. And Mike, I really got to ask about your importance of cumulative inflation, the societal emotion I feel every day, which is a 3-year lift in prices versus your granular focus tomorrow at 8:30 on month over month.
Well, we're looking at month over month because the Fed's looking at month over month. They're wanting to see continued progress being made and find the areas in which it is not, to see why it is not, if it doesn't continue going down. The American public are looking at the longer run because they're saying we came into the pandemic at these prices for Christmas trees or whatever you want, and now we got to pay these prices. And some things, commodity-based, go up and down in price, but a lot of other things the price gets raised and it stays that way. We were talking on Friday about how car prices, except for Teslas,
what are they doing right now? What are they doing right now?
Car prices have been going up, but used car prices have been going down dramatically. So that should put some weight on the core CPI tomorrow.
Very good. Michael McKee, thanks for that brief. Hugely important data. It's a Tuesday data. Tomorrow at 8:30, Michael McKee will brief. She has become acclaimed. Claudia Sahm was someone out of Michigan in the Fed a number of years ago with a really, really dry, smart academic paper on government assistance and how to decide wrapped around recession economics. She's literally become a household name. Dr. Sahm joins us now, former Fed economist, founder of Sahm Consulting. I guess congratulations. The only one, Claudia, had a bigger year than you was Taylor Swift. I expect we'll see you at a Kansas City football game anytime soon. Claudia Sahm, I've got to get it out of the way just because of the notoriety. How close are we to recession?
We're closer than we were, say, the middle of this year. We're not in a recession. And that's not just the Sahm rule. Look around, the economy is still growing. Now, that's no guarantee that we will be in that place, in the coming months, and yet we are not in a danger zone with the labor market. And there's a lot of reasons why we may have seen the unemployment rate come up that could be good reasons, like workers coming back.
What's important here, and you have it in your research note to us, and Bramo, I think, has really been out front on this, is almost the behavioral impact, think Thaler at Chicago, the behavioral impact of feedback loops. Tell us about what you're working on, the new, I'm selling this, folks, for Claudia. She needs something to do. The new acclaimed Sahm feedback loop. What's it look like?
Well, this is the logic. I mean, the Sahm rule is about the unemployment rate rising a relatively small amount. That happens early in recessions. It's been very accurate. The idea behind it comes well before me in that once the unemployment rate starts rising, it keeps going. Because on the demand side, there's this feedback loop. Some people lose their jobs, then they buy less, then those workers lose their jobs, and so on and so forth. And that's where it really gets going. What we see right now is not just the demand side, which would be a typical path into a recession. We see this, workers have really come back. We've gone from labor shortages to now some workers that are looking for jobs, right? It's going to take the jobs longer to catch up. That's a good thing. We needed those workers. It's just, as with everything else in this economy, it's been messy to line up supply and demand. So now it's in the labor market.
How uncomfortable does it make you to say this time is different?
Very uncomfortable. And yet, we could have said many times since the pandemic, this time is different, and very legitimately. I talk about the quote-unquote Sahm rule breaking, which is it would trigger, and then we would not go into a recession. Last year, we saw 2 quarters of declines in GDP growth that has only happened inside of recession since World War II. It happened, and we were not in a recession. So the Sahm rule could be next in line to break, and I prefer it didn't. I prefer unemployment stay low, but if it did, my base case is we don't go in a recession.
Does this mean that right now you see sort of the immaculate disinflation, or you see just year over year inflation come down to the Fed's target by later next year without necessarily the Fed doing anything more, and even potentially cutting rates like so many Wall Street firms seem to believe?
I take issue with the idea or the term of immaculate disinflation. This is coming out of a pandemic. We know where this is coming from. It's not just like it appeared. And yet, to your point, we've already seen it. right? And there are not all the disruptions worked out in the economy. The labor market's a place where we've seen some of like the kind of last momentum. There is more to give in terms of inflation coming down. It's going to be messy. I expect tomorrow not to be a fun day in core inflation. And there is some of the demand to come out. And we've seen that wage growth has slowed back to something more normal. So everything is rowing in the right direction on inflation. It's just going to be slow and bumpy.
Can you draw a distinction, Claudia, between people coming back into the market and the participation rate, which hasn't actually gone up so dramatically, even as we do talk about people coming back into the labor force?
When we look at the year as a whole, participation has moved up. That's a very slow-moving creature, just in terms of the measurement. We've absolutely seen a burst of workers. Women's employment is at an all-time high. We have seen a big surge of immigrants in terms of the work visas finally getting processed. So we've had people coming back in. It is there in the data and the labor force participation. And some of these factors are more temporary. And that's part of the jobs being able to catch up. Like, we're still adding jobs at a good clip, just not like last year.
Claudia, I don't mean to interrupt, but I think it's really important into the CPI data tomorrow and retail sales the next day. The Boston Fed has a cottage industry of trying to, this is Michelle Barnes years ago, folks, trying to figure out guessing consumption. Can we actually guess consumption? How do you respond to people talking about, well, this is the credit card data or that? What do academics like you actually say about gaming 70% of the American economy?
Right, so I was one of the lead forecasters on consumer spending at the Federal Reserve for about a decade. So I spent a lot of time trying to forecast consumer spending. The big piece, and I've talked about this recently, it's the income. Like, if we lose the labor market, we lose consumers because many people spend their paychecks. If we lose consumers, we're done. We're in a recession. So to me, it's like all eyes on the labor market, that it keeps in the place it is. And household balance sheets are in a place that they have not been in for a very long time, particularly at the bottom. Like, that's really encouraging.
Claudia, thank you so much. Claudia Son, former Federal Reserve economist as well. Lisa, to me, it's gaming 70% of the economy, and I strongly believe that little tidbit you heard there from Dr. Sam, which is an Econ 101, people spend their paycheck. Small matter.
Which is the reason why when Tom Kennedy came on and said that they're seeing people out of savings in the lower half of income families, then you end up with less discretionary spending.
Or, you know, I mean, there's ambiguities involved here, but I believe it was Honda with a 9% pay raise for U.S. labor off of the GM strikes. I mean, if you give people a 9% pay raise, what do they do with it?
Right.
They don't buy the triple leveraged all cash fund. They spend it.
What Claudia was saying there was fascinating to me, because everyone hates the phrase, this time is different, and yet we're kind of hearing that more and more from people who have gotten trained by a very difficult economic cycle with massive pandemic-era distortions that you have been talking a lot about, Tom, and correctly so.
I think we underplay the pandemic here as far out as we are. We also underplay the data, a little deterioration. Futures negative 13, Standard & Poor's 500 down 0.3%.
Coming up, we're going to be speaking with Stephen Englander, Standard Chartered Bank's global head of G10 FX research. And this comes at a time where there's really a question around the U.S. fiscal picture and how long the dollar will remain the haven bid if people actually start to worry about political dysfunction, as we were Monday at 6 p.m. Is that what you said when Moody's downgraded or put the U.S. on watch for downgrade from that AAA?
I really wonder I mean, I get why they do it. They don't want to roil the markets in that, but you know, there'd just be something more visible and open to immediate discussion and analysis by doing it at, you know, pick 10 a.m., whatever, pick the hour. Why bury it on a Friday afternoon?
Well, people had a weekend to digest it. It didn't seem to be roiling the market right now when people take stock of what they're saying, because they're basically stating the obvious, which really raises this question this week. What's the most important thing? Is it going to be Walmart earnings and Home Depot? Is it going to be what we get with CPI tomorrow? Or is it going to be the potential for a government shutdown?
I'm going to go beyond the consumer report. I was wrong last week on the 30-year auction, but I would suggest that the control group of said retail sales, which folds into Walmart, Home Depot, the control group taking out Guy Johnson in Abu Dhabi, in Dubai rather, taking out, you know, the rest of it as well is really key. It is a busy week, to say the least, including two presidents meeting in San Francisco. Anne-Marie Horton will have complete coverage of the Biden-Xi summit. Look for that here. Futures, -14. Lisa Bramlett and Tom Keene, stay with us. This is Bloomberg Surveillance.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We have been pretty sanguine on the probability of a soft landing for at least a couple of months now. We don't really believe that has changed very much, but we still also believe that the tails of the distribution remain fatter than usual. And we do think that heading into 2024, we could get a delayed but harder landing.
Sonia Meskin speaking with us last week, head of U.S. Macro at BNY Mellon Investment Management, as people coalesce around, I think, a soft landing. I think it's fair to say that, Tom, that there seems to be a consensus right now heading into 2024. It's early days, but that there's going to be some sort of soft landing with inflation coming down, unemployment not rising too much, and the economy slowing but not tanking.
I strongly agree that soft landing is the consensus, but it's how you get to a soft landing, which I think is so variable. And the distinction this morning, folks, of the Morgan Stanley, Goldman Sachs differential or separation, I should say, in outlook is Zentner's call for a higher unemployment rate than what we see from Dr. Hatzius.
Right now, a bit of softness to the tape in the equity space. Bonds basically range-bound, which is sort of unusual, although in the past couple of minutes, 10-year yields did tick up just a bit, 0.3% decline on the S&P. I wanted to take a look at two specific names, Home Depot and Lowe's. Home Depot reporting tomorrow. You mentioned this, Tom, earlier. Lowe's reporting next week. Both of them down on the year, not incredibly surprising given where mortgage rates are. Home Depot shares lower by 7.7% year to date, 2.3% decline on Lowe's. What I think is interesting is that they are poised for their first simultaneous declines in full year revenue growth since 2010. Just to give you a sense of where we are.
My sense of where we are, and I don't know what to do with this, and fully disclosure, I don't own shares. Walmart, present PE on the Bloomberg, 30. How does Walmart have I don't get how a store, I mean, I get they get operating leverage and they take single-digit revenue growth down to a lovely double-digit EBITDA, but, you know, that's like CFA 101. How does that equate to a 30 multiple? I just don't get it.
We're going to be looking at both the valuation side as well as the fundamental picture, but what you've seen for Walmart is they've been able to adapt to an Amazonification of the world, whereas Home Depot and Lowe's are still very much more tied to the housing market. Interesting to see whether they see some of the trends shifting or getting worse, since mortgage rates are not going down all that much.
Well, we're going to have to see here. The VIX up a stick, 15.12. I've got futures at -13. Bonds not giving me much love this morning after the festivities Friday. Critically, American oil, $77.03. On a Monday, we need a brief on foreign exchange. And out of his work at Yale University, Stephen Englander has been absolutely definitive over the decades. Global head of G10 FX research at the Standard Chartered Bank. I love in your research report, Stephen Englander, you can't figure out what to do because of the unreliability of the U.S. dollar. Discuss.
Well, look, I think the dollar's been a very macro trade, and it's reflecting the uncertainty about where interest rates are going and where the sentiment is going. And I think in particular, when we talk about the dollar smile, with the idea that the dollar can rise when things are very good or when things are quite bad. I think right now the market isn't sure where we are on that smile. You look at moments when equities seem very weak, and that would suggest a stronger dollar. Other times it looks like a weaker economy suggests boom time, and everybody's buying.
Catherine Mann, now at the Bank of England, and others would talk about the codependency of China and the U.S. on flows of money, of trade. Lisa, you mentioned earlier that whatever net in China has just gone to a negative for the first time ever. At this summit in San Francisco, Steve Englander, how does dollar dynamics and currency money big flow dynamics play into the summit and the tension?
Well, I think China is still trying to get the U.S. to relax some of the, what they consider to be unneeded sort of trade sanctions. I mean, I think the ship has sailed on ships that have military applications, but there's a lot of stuff that's got tariffs on it that probably nobody thinks needs them, except for political reasons. And I think that they're trying to see if there's a way of getting those removed. Overall, I'd say that would probably be a positive if there was some, for markets, if there was some progress. It's not going to be, a lightning bolt, but it would, on the margin, it would encourage some optimism.
Steve, how much do you care about Friday and the potential for a government shutdown?
I had to remind myself. Oh, the shutdown. Yes, indeed. Look, we don't think it's going to happen. Politically, there's no upside for the Republicans if they do it, and the signals they're sending is that it's going to be a relatively clean type of extension of the continuing resolution. If they do shut down, I think it will have a short length, and they will figure out some way of trying to get out of it with as much dignity as they can.
Well, but I guess that my question is, let's say there is a shutdown. I understand that it might be a remote possibility by a lot of prognosticators. Do you think it'll matter for the dollar? And that people will be more reluctant to buy, especially given the fact that we got Moody's warning on Friday?
Yeah, look, I think the market will look past it. They look, Moody's barely registered on any kind of scale. And I think the shutdown, if it's like, you shut down national parks, it matters a bit, but it's not going to be a big deal. I mean, basically the market's been trading off U.S. yields to a large degree, the FX market, that you don't care if it's real yields, inflation expectations, term premium. If you can get 10 basis points higher, they buy the dollar. And so I think that that's going to continue, at least in the short term, to be what's driving the market.
Steve, your ambiguity on U.S. dollar, I understand. I still need to have a trade today. You're the great cross-trade analyst. For Standard Chartered Bank, what's the most attractive 6-month trade right now?
Well, if you're looking at 6 months and if you have deep pockets, I think that the Japanese story is shifting quickly.
Give me the magnitude of that move. Give me the magnitude of the strong yen move we could see.
Oh, I'm not going to give you a number, but I'd say that one thing to keep an eye on is that every central bank that thinks it can gently get inflation to target. It's woken up one day and discovered it's way above target, and that they have to move much more on monetary policy than they anticipated. So to me, that's kind of the big yen upside that's coming, and just within a 6-month horizon, potentially, I'm not saying it's going to happen, but I think that could generate a lot of yen strength if that were the case.
You're not going to give me a number, though. Come on, it's Monday. Nobody's listening. Everybody tunes in tomorrow, Steve Englander. We're at a $151 yen. Give me some form of big figure move here.
I'm actually not going to do that, but I'll I think it would register on the scale. I mean, it would be, I'd say it's a first order FX move, not kind of
very good
up today, down tomorrow.
Always a class act. Steve Englander, thank you so much. The Standard Chartered Bank. You see, I struggle with that. I mean, I'm being completely rude there, folks, but I've known Steve for decades here with such a respect for his work. But he's saying here, at some point, they blink. And I'm going to make up these numbers. These are not Dr. Englander's numbers. Lisa, it's a $151 yen. And you and I are out shopping, holiday, spring, into the summer. And all of a sudden, it's 132.
And how much is this going to come with the nod from the Fed being able to
Right.
cut rates? And then it kind of makes their life a little easier. Just pointed out to us from Chris in the control room that the president is going to be welcoming the Vegas Golden Knights to the White House today to celebrate their Stanley Cup victory. How is it that Vegas is the center of all international sports suddenly?
Well, it's not suddenly. It's been over the years, and it's been a huge success there to see Vegas go out there with all sorts of heritage, the colors, the gold and the black, and to the Army in West Point. But it's been a huge success for the National Hockey League, and others are trying to mimic that. And I mean, when does a baseball team slide in? We've got the Formula One. Toto Wolff with us today from Mercedes. Are you going to watch that? I mean, are you going to be up?
I have to. I have to figure out whether they're going to slide all over the road.
1 a.m. on a Sunday?
Obviously, I'll be up. Honestly, though, this to me, we were asking, why is it that they're doing it in a place at night that's going to be 45 degrees out, that's going to be problematic for the tires?
Chris emails in from Dubuque. Chris, thanks for this insight. Because of the sports betting. It's that simple.
Do you actually think that's the case?
I'm not used to it yet, but everybody tells me it's complete, total. Michael Barr is adamant with Bloomberg Business and Sports.
About betting?
It's driving every discussion, including in hockey. Thanks for that email, Chris. Greatly appreciate that. On America's inflation. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Have you thought
maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Equities down by about 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, new week, same problems as shutdown risk lingers. Moody's taking a swing at America's fiscal health, and Wall Street unveiling outlooks for next year. We begin with the big issue, an unsustainable trajectory.
We're really on an unsustainable path.
Fiscal policy is an issue.
Fiscal policy, obviously, it's a concern.
Just awful fiscal dynamics that aren't going away.
As a signal of how dysfunctional the U.S. policymaking is.
Just moving from one congressional crisis and government shutdown threat to the next.
We're going to see probably another alleged crisis on November 17th.
Risk of government shutdown.
Looming government shutdown.
It's really the length of any potential government shutdown is the issue.
If it's more than a few days, you have some impact that can be felt from an economic standpoint.
I do worry about the credit agencies.
There's Moody's rating.
There's a risk of, economic slowdown and potential recession. This could add to that. We don't know what's going to happen.
Kind of an open question of how this all resolves.
Let's have that conversation right now with Academy's Peter Chair, Cameron Dawson of New Edge Wealth. Guys, great to catch up with you going into the opening bout to kick off this trading week. Cameron, let's start with you. Moody's taking a swing at America's fiscal health. A, is it justified? And B, does it matter?
Well, we haven't seen it matter much when we think about the downgrades that we saw earlier in the summer. But I think at the end of the day, we've had sort of the supply and demand dynamics around treasuries get put on the back burner for the market over the last couple of weeks as yields fell. But that could start to become something that becomes more top of mind. As we go into 2024, it's important to remember that that deficit to GDP is projected to improve a little bit to 6%, but that's in a strong GDP world, meaning that if you were to see nominal GDP start to come down or slow materially, and you see countercyclical measures, if we were to have a recession kick in, that could exacerbate debt to GDP more and then raise questions about, again, all those supply demand dynamics with treasuries. So I think it still should be top of mind for investors.
Top of mind for Bill Dudley, the former New York Fed president, with this to say on the situation. The situation is going to get worse because the government's debt is going to be repriced at much higher interest rates than we've had over the last 15 years. We do not have a very functional government in the United States right now in terms of getting things done. Two issues at play here, Pete. One is governance, the other is the debt pile. Let's deal with the latter, and then we'll get to the former later. The debt pile. Just how unsustainable is this, Pete?
I think it's completely unsustainable, right? We got away from the habit where we spend in bad times but kind of recover a little bit in good times. That's gone. As interest rates are rising, this is slowly kicking in. I mean, the Treasury did a decent job issuing long-dated bonds, but that's slowly rolling over, so the average coupon is going to tick higher. So just debt service alone is going to kick in more. And then let's not forget, the Federal Reserve was kicking in 150 to 200 billion a year positive profits that went back to fight the deficit. That's probably going to be a loss, if not this year, certainly next year.
Pete, looking at these numbers from Moody's, let's work through it together. Here's the quote from Moody's. They see federal interest payments relative to revenue and gross domestic product rising to around 26% and 4.5% by 23, respectively. That's up from 9.7 and 1.9. Pete, I'll go through that line again. They see federal interest payments relative to revenue and gross domestic product at 26% and 4.5% by 2033. Pete, underlying this is an assumption that we're in this higher for longer story, that these rates we've got to grapple with now are going to be sticking around. Do you agree with that, Pete?
No, I do think we're going to see some pressure on the economy. That's going to help take rates down. And ultimately, this is really going to come down to D.C., right? Can D.C. start figuring out a way to pay down some of the debt? Because that's the other factor, right? If we can get debt somehow down, which doesn't seem likely in today's environment, but it's going to be something they have to focus on, that will also alleviate that pain. So I think people are getting a little bit carried away that the higher rates are here to stay and that the debt trajectory is going to remain in trouble. So again, I think this is a problem, but it's not necessarily this year's problem. So I think that's where people maybe get too carried away.
Cameron, do you agree with that?
Well, I do think that there has been less urgency by Washington to pursue fiscal prudence or austerity. And part of that is because it seems to be less of a top of mind issue for the average voter. Because if we go back to post-Great Financial Crisis, that's when voters were very concerned about fiscal deficits. So it will be important to see if that starts to shift as we go into the election cycle next year. If that becomes more top of mind for voters, then it could be something that becomes more top of mind for Congress, and then we could see some different dynamics about spending and actually finding that prudence.
Well, let's talk about the prospect of finding that prudence down in Washington, D.C. Bloomberg's Anne-Marie joins us now for more. AMH inching towards another government shutdown.
Yep, Jonathan, we were exactly here where Speaker McCarthy lost his job. So now this is another high-stake negotiation for a new Speaker of the House, Mr. Johnson. Over the weekend, he outlined his plan, Jonathan, and it's a twist for a normal continuing resolution because now this would fund parts of the government to January and the remainder of it until February. So it's a two-step process because obviously the hard right flank of his party want to see cuts, and this is a clean resolution, so potentially giving some of that two-part scenario shows that he really wants to get these individual appropriation bills done. He took to Twitter, Jonathan, he said, Washington's spending addiction cannot be broken overnight, but I will not allow end-of-the-year mega-bust spending packages to continue under my leadership. The issue, Jonathan, is he's going to lose some Republicans. How many Democrats are going to be able to vote for this? The White House is calling this a gimmick, a recipe for more Republican chaos, but there's no poison pills in it. So if Democrats don't vote for it, could they be the ones potentially blamed for a shutdown?
What's the difference between what this speaker is trying to achieve and what the last speaker was trying to achieve?
The fact that it's a two-tiered approach, Jonathan, but it is a continuing resolution. A stopgap funding measure keeps the government open, and there's no big cuts to it. It's pretty much the same.
On the latest down in Washington, on the latest effort, which looks a lot like the last effort. Anne-Marie, thank you. Peter Scheer, Yellen says there's nothing to see here, that the debt position is good, it's fine. The usual line, the same line that we heard from the Treasury after Fitch made a move in early August. From your perspective, Pete, and I think this is important, just how safe is the so-called safe asset?
You know, first, I think she has to say that because that's her job and it's ultimately a political appointee. So I take everything she's saying with that in a grain of salt. I think people are starting to question where they want to be in treasuries and where they want bonds. So we're having a lot of conversations. If treasuries are still safe, but maybe not quite as safe as they were, how do you position yourself? And I'm not worried about default at this time, but I am worried about this volatile trading that we're seeing and this potential for gap risk. So, you know, you start seeing maybe days we go 50, 70, 80 bips higher in treasuries down the road in a day. I think that's what I want to avoid. So I'm looking at floating rate debt. I'm looking at corporate debt. And to be honest, you watch Bitcoin's been doing very well, and I'm not necessarily a fan of crypto, and part of that's obviously been what's going on with the potential launch of the ETF, but I do believe some people are saying, hey, if maybe not 100% of my safe asset should be in treasuries, I should find something else. And I think that's a trend that's going to continue until something gets solved out of D.C.
Cameron, are you looking elsewhere for so-called safety?
Yeah, I mean, I do think we have to respect the uptrend in long treasury yields, meaning that, yes, we had this movement lower, and that really led people to say, we've had the peak in yields, treasuries can be safe again, and yet we pulled back to the 50-day moving average. We still are kind of drifting higher, which means that we still have that prospect for higher yields, which just means that the call to move everything from being a short duration fixed income and piling into long duration fixed income for that kind of safety trade, likely still is premature. So it's not to say that you can't extend duration in certain areas, but you have to do it very carefully because the 10-year is still in an uptrend.
Pete, we had this conversation with Neil Kashkari, the Minneapolis Fed president. We alluded to some of these difficulties, and Pete, he made the point, and I think it's an important point as well. If there were concerns about financing the deficit, why was the dollar stronger and not weaker? Pete, what would you say back to that?
You know, I think, one, there's a lot going on with the dollar. I think Japan's been fairly weak and having problems there. I think the U.S. economy is strong, so that's part of it. People do need dollars. So, and again, I think part of what Cameron just said is also very correct. People aren't necessarily shifting completely away from treasuries, so they are buying T-bills, though, rather than long-dated treasuries. So maybe they're buying more of them. We'll give that time to see how it plays out. Again, I think the one thing, none of this is going to happen in a day, a week, a month. I think this is multi-year trade. I keep coming back to the great financial crisis. Started initially cracking in 2006, and it wasn't until 2009 that we bottomed.
It takes a while to play out. Pete, stick with us. Alongside Cameron Dawson, we'll talk about their outlooks for 2024 in this equity market specifically in just a moment. About 20 minutes away from the opening bell, equity futures on the S&P pulling back 1/3%. Let's get you some movers. Here's Abby.
John, let's take a look at two leaders ahead of looking at one of the drags, at least on the NASDAQ, starting out with the shares of Tesla and then Boeing. Both of these companies moving on news having to do with other countries. Tesla is higher, up about 0.8% as India is weighing a 5-year tax cut plan on EV imports, trying to get Tesla to both sell Tesla cars in India and potentially to manufacture them at some point. Boeing up 4% as China is weighing in ending its freeze on the 737 MAX deal. And then finally, Plug Power heading to a 6th down day in a row, a member of the NASDAQ composite last Friday, down 40%, the worst day since 2014 on a bad quarter and going concern risk. Well, today, Morgan Stanley has cut its target on that warning. It seems as though Plug Power can't get a break, John.
Abby, thank you. More from Abby around the opening bell. Just keep an eye on Boeing. Positive in the pre-market. We are expecting a bit of a charm offensive from Chinese officials coming to the United States later this week. We'll talk about that a little bit later this morning. Coming up on this program, Goldman and Morgan Stanley diverging on the Fed's road ahead.
We're still faced with this pretty bearish, pretty pessimistic setup, which continues to allow pretty positive surprises.
Wall Street unveiling their latest Fed bets ahead of a big CPI report tomorrow morning. That conversation up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
going to get, core PC inflation below 3% by the second quarter of next year, right? So it's not miles away. It's not like we're talking about, sometime in 2025. We're talking about in 1 or 2 quarters, 1.5 quarters. And suddenly, perhaps, real rate, the real federal funds rate, is then going to be way, way, way too restrictive. And then the market and the Fed can start talking about rate cuts. You're actually going to continue seeing a pretty Goldilocks-y environment.
I've got no idea what that means, but that was Max Kentner of HSBC saying Goldilocks is back. It's that time of the year. Crystal ball time, looking out to 2024, a tale of two Fed outlooks, Morgan Stanley versus Goldman Sachs. Goldman expecting fewer cuts and a later start. Morgan Stanley anticipating deeper rate cuts over the next 2 years, ending in the low 2% range in Q4 25. Morgan Stanley's Ellen Zentner writing this: we maintain our view that the Fed will achieve a soft landing, but weakening growth will keep recession fears alive. Mike McKee joins us now for more. Morning, Mike.
Morning, John. With apologies to Ellen and David Miracle at Goldman Sachs, I kind of put this in the category of all the political polls we've been reporting on lately. Value add? Nothing. It's years away. Take a look at the latest dot plot from the Fed. I put Morgan Stanley and Goldman Sachs into the 2025 numbers there, and you can see they are sort of right in line with everybody else. They're far apart. The Fed doesn't know. Nobody knows. It's 2 years away. How do we even make a sense of any kind of predictions about what's going to happen there, given what we've been through for the past 3 years? Instead, we just kind of have to slog through the data release by release. Today, we get the New York Fed's inflation expectations numbers. And then tomorrow, as John mentioned, CPI. How important will it be? We're still 5 weeks out from the Fed meeting, so it may give people something to trade on, but it's not going to be dispositive for the Fed. Same with retail sales, jobless claims. The rest of the stuff that is on the list it's just not going to be as let's say, future predictive as people on Wall Street would like. We have a lot of Fed speak again, 20 appearances this week, 11 different Fed speakers. And I think we could probably, John, put the conclusion out already that they're basically all going to say data dependent and we're going to move carefully because they've got 5 weeks to go. It's one of those rough times, and Will Compernol of FHN Financial probably put it best. And he said that in his note today, that what Wall Street is looking for is an anchor for what Fed policy is going to be. And there is no anchor at the moment. We don't know if it's going to be inflation. We don't know if it's going to be jobs. We don't know if it's going to be the wars overseas. A lot could happen that would change narratives between now and 2024, let alone 2025. And that's the hard part for people who are investing at the moment.
Oh, Mike, it's difficult to get past next week. I think we say that all the time on this program, never mind 2024 and 2025. Mike, when you look across the data set we get this week, how much weight would you put on, say, CPI versus retail sales?
Well, I think CPI is going to be more important in the sense that it will give us an idea of whether the Fed is still making progress, and that will sort of inform, if not confirm, people's views of what might happen at the December 13th meeting. But retail sales will also tell us something about whether Americans are still spending, and that's always been the surprise every month, that Americans continue to spend money that economists have forecast they'd run out of.
It's held up so well. It's ridiculous. Mike McKee, thank you, sir. Peter Cheer, Cameron Dawson back with us. Pete, what we see in the data so far, consumer sentiment a little bit lower, claims a little bit higher. Is the slowdown coming next?
Yeah, I think we're already started that slowdown. We're seeing lots of little anecdotal evidence, whether it's in freight, whether it's in shipping. It hasn't come in completely in the numbers, though the last month's job numbers were not great. So I think we are in the midst of this slowdown. I think we're going to get maybe not a hard landing, but something less than a soft landing. I think people are going to get nervous about the state of the economy, and the Fed is going to have to balance that with the fact that there are inflationary pressures. And whether you want to call it geopolitical inflation, ESG inflation, reshoring inflation, those pressures are real. So that's going to be, I think, a difficult balancing act for the Fed to deal with.
Pete, I remember when you, Mitch, used to make this Federal Reserve nervous. What changed?
That I do not know. And they do tend to look at, again, I've never completely understood why they fixate so much on consumer expectations. Right. I always go back to Michigan and Consumer Confidence Report. It tends to reflect what gas prices have done and what the stock market have done. So I've always ignored it largely.
That was what was odd about Friday, because gas prices have come down a little bit, but Expectations for inflation just shifted a little bit higher. Two-part question for both of you. Cameron, I want to come to you. Is Q4 too soon to see this economic slowdown materialize in a more pronounced way? And do I still have a window to be long equities going into year end?
Yes and yes, meaning that, so for the Q4 slowdown probably being far too soon, is that we're unlikely to see that sharp deterioration in labor data going into the end of the year, and that it really is more of a 2024 question, which just means that consumer spending, though maybe getting continuously pinched by inflation, can continue to remain elevated or healthy simply because when consumers have jobs, they will continue to spend. And so I think that that really will keep equities supported into the end of the year, as well as all these dynamics about window dressing and no tax loss harvesting in the largest names in the index. The thing we have to watch really closely is earnings revisions, because we've started to see them erode for 2024. Part of that is because economic surprises have turned meaningfully weaker over the last couple of months, meaning economic data is not surprising as much as it was. So if that continues and we see earnings revisions continue to erode, that could be an interesting setup for 2024.
Pete, do you look at things the same way?
Similarly, I think there's more chance that we see some recession data creep in Q4. Having said that, though, I think that will just help keep yields lower, so stocks can probably rally on that. And we are watching really closely what's going on in these talks between China and the U.S., right? With so many problems going on geopolitically, there is a chance that the Biden administration reaches out an olive branch to keep China calmer while we're already dealing with Ukraine, while we're dealing with what's going on in Israel. And so that could be a big positive for markets. I think it would probably be a long-term bad step, but it's something that we could see happen.
Pete, you've got a firm filled with generals. Let's just sit on that topic just for a moment. China and the United States, Xi with Biden. You mentioned some of the reasons for Biden maybe to go on a charm offensive. Do you think there are bigger reasons for China to do the same thing, given the data point that we've seen in the last week or so, to see foreign direct investment into China turn negative? How important is that data point going into this conversation?
So I think there's two things about that. One is at a very high level, anything that's national security risk, that's going to stay off limits. So that we're not going to cave in. We're not going to do anything to help China in that respect, because it is a very serious thing. But the key is, what can you do that's not national security interest that allows some re-globalization to occur? And yeah, I think China has to look for some short-term investment, though I do think we're seeing evidence of what we've been calling this made by China strategy, where China is selling their brands into more countries, particularly emerging markets. So some of that foreign direct investment may start coming from other countries over time. But yes, I think both sides would probably do well right now to come to some sort of deal. And it feels to me, though, that China's probably a little bit more in the driver's seat, given that they are not in the midst of all these geopolitical issues and deficit issues.
Hey, Cameron, we've got a stacked calendar this week. Let's just finish on what's big on your radar. We've got data, CPI, retail sales, earnings, Walmart, Home Depot. We've got Fed speak, tons of it. Then you've got geopolitics. What's big on your radar this week?
Yeah, it's all about the consumer and seeing if there is any deterioration in retail sales and what Walmart and Home Depot are saying about the health of the consumer. We know that consumer balance sheets are still relatively healthy. They're really back to about 2019 levels when we look at things like percentage of revolving credit or looking at things like credit card delinquencies. But as savings are whittled down, will we start to see the consumer tighten the belt? And then that leads into the question of, will this holiday season be a source of upside surprise or a downside surprise when it comes to consumer spending?
I'm with you. Cameron, thank you. Alongside Peter Cheer, Cameron Dawson there on the latest, going into a stacked week. Talking about the consumer, retail sales Wednesday, CPI tomorrow morning, then tons of retail earnings in between to try and get your hands around. Equities right now slightly negative on the S&P 500. We're down a third of 1%. Coming up, the morning calls, and later, Goldman and Morgan Stanley unveiling their 2024 equity outlooks. That conversation still ahead. We'll get the views of BlackRock. Tony DeSpirito, the US Fundamental Equity CIO, joining us around the opening bout from New York. This is Bloomberg.
this story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Squeezing out 2 weeks of gains on the S&P 500, 5 minutes away from the start of a brand new trading week. Equity futures just a little bit softer, down by a third of 1% after a really impressive finish to last week in Friday's session. Even with this move in the bond market, shaking off the fact that the 2-year is back north of 5%. At the moment, the 2-year up another basis point to about 5.08%. Just one to watch, keep an eye on through the trading session. That's some of the price action. Let's get you some morning calls. First up, Bernstein upgrading TripAdvisor to outperform, expecting a return to profitability due to strengthening travel demand next year. That stock is up by a little more than 2%. Your second call from Citi, upgrading HP to buy, $33 price target, pointing to bullish PC momentum and potentially higher free cash flow generation. That stock is up by a little more than 1%. And your third and final call from Odeon Capital, downgrading Regions Financial to hold, highlighting the stock's historically soft performance during periods of economic weakness. That stock is down by almost 1% in early trading. Coming up, strategists unveiling their equity outlooks for the year ahead. Goldman Sachs and Morgan Stanley not seeing eye to eye. That conversation up next with BlackRock's Tony DeSpirito. Tony's joining us shortly. Your opening bell is just around the corner.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Seconds away from the opening bow this morning. Good morning to you all. This week is absolutely stacked. CPI coming up tomorrow morning, retail sales on Wednesday, tons of earnings in between. And for those of you who like it, I know a lot of you hate it, got a sprinkle of Fed speak in the mix as well. Your opening bell rings in New York City. Switch up the board and get to the bond market. Yields look like this on a 10-year, higher by 2 basis points. 467.57 on a 10-year after a sloppy bond auction on a 30-year maturity last week. Spooked equity investors for the best part of about 5 minutes before bouncing back. In the FX market, the dollar showing a bit of strength, the euro some weakness on that currency pair, pulling back 0.1%, 106.74, and crude just about positive on the day by, let's call it, 6 cents, up about 1/10 of 1% to $77.22. Your broader equity market about 30 seconds into the session looks like this. We're negative by 0.3% on the S&P, down by about 0.4 on the Nasdaq. One stock to watch at the open is Boeing, as China considers ending a freeze with its 737 MAX. A Boeing executive saying, quote, "Our job is going to be express to the Chinese the need to replace their fleets and provide growth for the future." Abby has more. Hey, Abby.
Hey, John. Well, the stock is certainly popping on this, up more than 3%, heading to its best day potentially since July. And it is on this news that China's freeze on the 737 family could end, a clear positive for Boeing and potentially the country as well, a bit of a thawing amid tense trade relations. Now, for Boeing, it represents a chance to jumpstart sales of its narrow-body jet that, of course, has been grounded to some degree, and no pun intended, since 2018 when there were 2 air crashes. China has not made any significant purchases over that time. So as a result, Airbus, its competitor, has really taken a lot of market share. Now more than 1,000 of their jets are out there, whereas Boeing has really stayed stalled since 2018, right around 950 jets or so. Now, they do have apparently 85 737 MAX jets in storage intended for China, and restarting those deliveries could help the plane maker reach its target of shipping between 375 and 400 of the jets this year. Clearly a positive. The Xi-Biden meeting at APEC in San Francisco on this week, John. Well, clearly it's opening the possibility of a door to restart and reset trade on aerospace. Unintended positive, perhaps, and the stock, again, best day since July.
Just a little bit more constructive. Abby, thanks for that. The stock is up by a little more than 3%. Let's turn to pharma. More good news for Novo Nordisk, as its weight loss drug shows it can help reduce heart attacks and deaths. The CEO saying this: physicians are understanding that this is not just about weight and appearance, it's about real health benefits. Madison Muller joins us now for more. Hey, Madison.
Hi. Yeah, so it seems like it's weight loss drugs all the time. There is news every single day. Today, the story is Novo Nordisk reporting details from a very closely watched study of its weight loss drug Wegovy over the weekend at a medical conference in Philadelphia. And what we're seeing is that there might be benefits for patients' health beyond just that weight loss. So in this study, heart attacks and strokes were cut by 20%. And that's due to anti-inflammatory effects, reduction of blood sugar. This is the first in many studies that are happening that we're really starting to see all of the potential benefits of these drugs for patients beyond just the number on the scale dropping. So it's an exciting time for Novo Nordisk. There's some read-through to Eli Lilly, which is also developing a weight loss drug called Zepbound. And it remains to be seen what the other knock-on effects of these drugs will be.
This could totally change this economy. Madison, thank you. That stock's a little bit lower this morning. We're down 2.7%, but year to date, Novo Nordisk is up by something close to 50%, up by about 47% on my read on the Bloomberg right now. Let's turn to consumers. JD.com reporting sales growth after Singles Day in China, but newer social media platforms outpacing them. Katie Greifeld on the story. Hey, Katie.
Hey, John. Yeah, Singles Day. It's China's version of Black Friday, and signs this year point to it being a little bit of a letdown. You had both Alibaba and JD.com choosing to not disclose their overall revenue figures for a second year. So it's hard to know for certain. We did hear from the companies. Alibaba said that sales growth was positive, and JD.com said that revenue hit a record. That's, of course, the company line. Meanwhile, you take a look at analyst estimates, estimates that point to both Chinese e-commerce giants likely only seeing double-digit or single-digit gains, even after, of course, that heavy discounting period to draw in reluctant customers. Now, given that Singles Day has become this barometer for Chinese consumer sentiment, this is perhaps another worrisome signal. You did mention, of course, some of the smaller streaming platforms maybe saw double-digit sales growth. That is according to Bloomberg intelligence estimates, but that's little comfort to JD.com. You can see shares about 0.1% higher right now, though they've been fading basically since the bell rang.
Pretty much unchanged now. Katie, thanks for the update. Appreciate it. Let's turn to earnings. Tyson Foods missing estimates as it deals with higher costs. The CEO saying this: while economic headwinds persist, we are moving in the right direction and managing what we can control. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, losing money across beef, chicken, and pork segments, but the focus really in the pre-market where shares were down, now we're seeing them a little bit higher, was on the beef, taking an impairment charge of $333 million on its beef operations in the fourth fiscal quarter. Now, part of this is overall what's happening in the beef sector. There are fewer cattle available in the United States. The U.S. herd is actually its smallest in almost a decade. So that means that producers like Tyson have to pay more for their fat cows, and that erodes profits. Also, the CEO talking about how this impairment is also due to higher interest rates. When we look through the earnings, see a little bit more of a mixed picture. Earnings per share were a bit ahead of estimates, adjusted 37 cents to the 25 cents analysts were expecting. Down, however, 77% from a year ago. Sales coming in just a little bit light at $13.35 billion. And the outlook is not particularly better next year, saying that the revenue outlook's relatively flat in 2024. With chicken production expected to really speed. The company trying to cut costs where it can, hoping the chicken business picks up, but shares are down 23% this year. Maybe that's why we're seeing a little bit this reaction, not as bad as potentially feared, John.
Tiny bounce. Simone, thank you. Up by close to 2% there, about 47.90 on that name. 6 minutes into the session, broader market looks like this, negative 0.4% on the S&P, down about 0.5% on the NASDAQ. It's outlook season. It's that time of the year, crystal ball type stuff. Goldman Sachs, Morgan Stanley, diverging over the outlook for stocks next year. Goldman's David Kostin writing this: many investors are concerned about downgrades to consensus earnings forecasts, but they're tracking in line with the typical patterns. A less optimistic Mike Wilson over at Morgan Stanley writing this: the near-term backdrop remains challenging. Earnings revisions breadth has rolled over once again, and underpinning this trend is more cautious corporate commentary. These factors suggest earnings headwinds will likely persist into early next year. Let's start the conversation now with BlackRock's Tony DeSpirito. Tony, two views there, two peers, Morgan Stanley, Goldman Sachs, Wilson, Kostin. Let's get to your view for next year. How difficult is it to go into the crystal ball and look out to 2024?
Yeah, so I think in terms of the outlook for stocks broadly, we're about in line with historical averages. You know, I look at equity risk premium, and you know, we're a little lower than average, but pretty much in line with historical averages. So I feel comfortable there. And then where I feel really excited is the opportunity for stock picking. I see a lot of dispersion. I see dispersion in valuation. I'm seeing dispersion in earnings. And I think that's really good for skilled stock picking. So I'm kind of medium on the market overall, but very optimistic on the opportunity for stock pickers like myself.
Tony, let's get into that just a little bit more. The approach post-GFC, after 2008, 2009, where you just hugged the index and didn't let go, and you benefited from that. And I wish people understood that at the time, because of course it sounds easy now, but at the time it wasn't. Tony, how different is this regime going to be compared to what we witnessed over the previous 10 years?
Yeah, so I think very different. that post-GFC regime, I call it the buy the dip error, where the Fed was constantly fighting deflation with easy money, ultra low rates. And what that resulted in was very high returns. Actually, equities in the US were up over 17% per year during that whole time period, which is a long time. And volatility was depressed versus historical averages. Going forward, we're going to have this push and pull about inflation, but secularly, there's just going to be more inflationary pressures going forward. So instead of fighting deflation, the Fed's going to have to periodically fight inflation, whether it's because of demographics slowing, whether it's because of deglobalization, what's going on with the US and China, that's inflationary, reshoring of supply chains, or decarbonization. All of these things are inflationary pressures. And so that means the Fed's going to have to constantly be fighting inflation, raising rates. And I think that creates a very different outlook. It creates one that's more neutral for stocks. It's fine, but more neutral. And then also it means more volatility, and the volatility is what's good for skilled stock pickers. And I say skilled stock pickers because we all know alpha is a zero-sum game.
Tony, with that in mind, just given what you said about the Federal Reserve, what's the argument for equities over fixed income in the regime you just described?
Yeah, well, I think it's much more like go back to history. And so one of the things that we did was we looked back since 1957 when the S&P 500 started. And if you look at that time period, actually the average 10-year treasury during that time period is 5.75%. So yeah, today's rate of 4.65 or 4.67 may look high relative to what we've gotten used to in the last 15 years. But by historical standards, it's still pretty modest. And in that kind of environment, I think equities can outperform bonds.
Tony, we're trying to work out where we are right now before we look out too far into the future. Where do you think we are in the cycle? And given that, what should that mean by where you should be in this equity market?
Yeah, so I just described the secular pressures towards higher inflation. I do think cyclically we're in a period of disinflation, which is good. And that means we're kind of in this Goldilocks state where the economy has been able to be strong while the Fed has been able to take the heat off of inflation. So no one's worried anymore about a inflationary spiral. So I think that's pretty good. But we have to recognize that we're in the later stages of the economic cycle. Unemployment is pretty low, 3.9%. There's not a lot of slack in the economy. And so what I see is my favorite trade is the up in quality trade. A real focus on quality of business, quality of balance sheet, quality of management teams. And historically, this is the time to own quality. Quality tends to outperform in the late stages of an economic cycle. It tends to outperform after the Fed is done hiking. Yet, when I look at the marketplace, quality is actually trading at a discount to its historical multiples. So usually quality trades at a premium to the S&P 500. Today, it's at a slight discount to the S&P 500. So I think it's a great opportunity for investors to move up the quality scale. That's what I'm doing in the funds I run, like the equity dividend fund, for example.
Tony, with that in mind, why do you think it is trading at a discount?
Yeah, I think it's a little bit, investors are chasing the new thing. We've had a lot of great themes this year, like AI, like the GLP-1s, the weight loss drugs that you talked about before, et cetera. And so I think there's a little bit of tendency to just chase momentum as opposed to really dig in to quality and valuations and margin of safety. The result is that's where the opportunity is.
Tony, appreciate the update from you, sir, as always. Tony DeSpirito there of BlackRock on the year ahead and the cycle ahead of us as well. Your broader equity market at the moment is negative 0.4% on the S&P. We're down about 0.7 on the NASDAQ. If you'd like an update on the bond market, I'll give you one just briefly. Yields are higher at the front end by about a single basis point, just north of 5%, 5.07 on a 10-year currently up by 2 or 3 basis points. Your 10-year currently at 468.37. Further out along the curve, we had that disruption, didn't we, at the back end of last week, that sloppy 30-year auction, things settling down just a touch. We're higher by 4 basis points. Your yield there, 480. Coming up on a program, looking for China's charm offensive.
When it comes to managing the relationship, ties and communications between our two militaries are critical. The Chinese have basically severed those communication links. President Biden would like to reestablish them.
That's the goal of this week. Xi meeting Biden. That conversation up next.
Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
When it comes to managing the relationship, ties and communications between our two militaries are critical. The Chinese have basically severed those communication links. President Biden would like to reestablish them, and he will look to this summit as an opportunity to try to advance the ball on that.
National Security Advisor Jake Sullivan there, setting the scene for high-stakes diplomacy in San Francisco this week between the US and China. Presidents Biden and Xi meeting face-to-face for the first time in a year, both looking to stabilize shaky ties. The meeting opening a door to reset trade on aerospace as China weighs a commitment for Boeing's 737 jetliner, ending a long commercial freeze in a critical overseas market for the US plane maker. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lines in Washington, D.C. AMA, set the scene for us this week.
Well, Jonathan, the two leaders, Joe Biden and Xi Jinping, will be sitting down, leaders of the two biggest economies for the first time in a year. But, Jonathan, there's no clear breakthroughs that the administration is outlining or the Chinese government is outlining, but there's going to be a slew of items on this agenda when it comes to geopolitical concerns, economic concerns, human rights concerns. But it seems like the one potential deliverable, if you want to call it, will be more communication, military to military communication. So basically, going back to the normal cadence of dialogue between Beijing and Washington before then Speaker Pelosi took that trip to Taiwan last summer, Jonathan.
We've talked a lot about the potential for a charm offensive here on both sides. Katie Lines, is Boeing the winner of that?
Well, at least the shares look to be on reports that they could indeed be a winner of a thawing of relations between the U.S. and China, because according to Bloomberg's reporting, citing sources familiar, China could be making a commitment to the 737 MAX at this APEC summit this week. Remember, this is an aircraft that has not seen a massive order in China since at least 2018, after it was grounded by China globally, and then globally in March 2019 after a series of crashes. But part of the concern was no longer just safety concerns. All of that largely largely has been put to bed. It was really an issue of the relationship between the U.S. and China and the real freeze that it had on commercial activity. So China's potential commitment that they could unveil, though the sources familiar who have spoken to Bloomberg have suggested this isn't final, things could still change. Nonetheless, would be a really big win for Boeing in a market where they have been consistently losing ground to Airbus. It is the A320 that has well overtaken Boeing to be the most used single-aisle aircraft in China. So this could be a big win for them. But of course, Boeing is notching up other wins in other areas as well. At the Dubai Air Show earlier today, Emirates committing to a $52 billion deal to buy 777X, that wide-body aircraft. So a couple wins for Boeing here, and you're seeing the stock reaping some reward this morning.
Expect more from Guy Johnson on that in the next couple of hours. I'm looking forward to Guy's view on things. Anne-Marie, just to come back to you and talk about the two meetings that are taking place. It's not just Biden and Xi. It is also Xi with business leaders in America. Anne-Marie, how key is that going to be?
Well, listen, Jonathan, Xi Jinping clearly wants to bring in foreign investment. He wants to make sure that business leaders know that China is still open for business. You saw the number of CEOs that were there over the course of the last few months, like Jamie Dimon, like Elon Musk. China is still struggling economically. There wasn't this massive pandemic resurgence of their economy that we've seen happening, say, in the United States. They have a very high unemployment rate. They have a dwindling and a lot of pressure on their property market. So for Xi, this is a really important meeting, but also for these executives that want to know what it looks like to continue to invest in China. So for Xi, I would say this is almost as important as his meeting with President Biden, but obviously sitting down with America Inc. CEO for President Xi is going to be paramount.
Would you go as far as saying that this meeting, this visit, is more important for Xi than it is for Biden?
Potentially, when you look at the state of the Chinese economy versus the U.S. economy, I would say this is incredibly important. We also have seen a number of U.S. officials go to China. This is the Chinese president's first visit to the United States in years, Jonathan. And it's not just going to be with President Biden. There's a number of other leaders attending the APEC forum, but also with executives. But remember, he has not really taken a ton of trips following the COVID-19 pandemic. So for Xi Jinping, this is a really important moment coming to the United States.
Katie, I joked earlier that maybe cities across America would like Xi to visit them because a big cleanup act has taken place, hasn't it, in the last couple of weeks in San Francisco?
Well, yeah, that's very true. It's interesting that the summit is happening in a city that has really been a focal point for a lot of issues, including crime being one. But to Anne-Marie's point about how Xi has a lot at stake here when it comes to the Chinese economy, for President Biden as well, while this is a really high-profile accomplishment, if you will, on the geopolitical stage, being able to meet face-to-face with Xi Jinping and resume more normalization of ties, as she said, the military would be a big win. We have to keep in mind, this comes off of Bloomberg polling last week that showed the president is really falling behind former President Trump in swing states on foreign policy issues on which they trust former President Trump more. And foreign policy issues just aren't resonating voters with the same extent that issues like the U.S.-Mexico border are. So how much does the China win really help the U.S. president? At least electorally, that remains very unclear, John.
And in that poll of ours, big margins on those fronts. Katie, thank you. Katie Lyons alongside Anne-Marie, AMH down in Washington, D.C. You brought a market 22 minutes into the session. Equities negative 0.4%. Let's get you some sector price action. Here's Abby.
So that's a relatively modest decline for the S&P 500, John, but it is broad-based. If we use the IMAP and the Bloomberg terminal to take a look at what's happening beneath the surface for the S&P 500, most sectors, 8 of the 11 sectors are lower, and industrials, in fact, up ever so slightly to the downside, real estate, and then those 3 mega-cap tech sectors all down more than 0.5%, dragging. Energy is up just a little bit, up about 0.5% as oil gets a bit of a bid. And then consumer staples, a defensive sector, also higher. Now, you were mentioning earlier that retail sales out on Wednesday, and then a lot of these big box retailers such as Home Depot tomorrow, Target on Wednesday, TJ Maxx on Wednesday, reporting this week. Ahead of that, we're looking at the best month for the discretionary retail index going all the way back to June. So it seems some investors are optimistic.
A bounce there. Abby, it's been a difficult time for them going through the summer, particularly some of the airlines really struggled from, I think, the peak back in July, really started to roll over, maybe softer demand domestically, higher fuel prices. Let's see if we can unwind some of that. Abby, thank you. Coming up, I've said it a few times in the last few hours this morning, an absolutely stacked week ahead. I'll bring you the calendar, the trading diary, up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
25 minutes into the session, early days, just starting the week on a softer note. We're down about 0.5% on the S&P. That's the price action. Here's the week ahead. The trading diary absolutely stacked, packed. Tuesday, we'll get US CPI and Home Depot earnings. Wednesday, US PPI, US retail sales and earnings from Target. Plus, President Biden meeting with President Xi Jinping at the APEC summit. Thursday, another round of jobless claims and earnings from 3 more retailers, Macy's, Walmart, and The Gap. And finally on Friday, it's the US government shutdown deadline expiring at midnight. There's a week ahead for you. A quiet start to a very busy week, which picks up big time tomorrow morning with the US CPI. Looking forward to covering all of that with you. Thank you very much for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to get political. Nathan Dean, Senior Policy Analyst of Bloomberg Intelligence, and Jordan Fabian, White House reporter with Bloomberg News, join us for a roundtable discussion of the potential U.S. government shutdown and President Biden's upcoming meeting with Chinese President Xi Jinping. That should be in the news. We're also going to check in with Philip Colmar. He is the managing partner and global strategist at MRB Partners to get his thoughts on these markets. And then apparently Boeing sold a bunch of planes to Emirates Airline. So we're going to check in with George Ferguson, senior aerospace analyst with Bloomberg Intelligence, and see what that means for our good friends at Boeing. But first, let's kick things off. Nathan Hager down in Washington, D.C. has got a Bloomberg Business Flash for us.
I can tell you what those deals mean for Boeing stock, Paul. Right now, it's up 4.7% off the back of some of those deals we're hearing about on the Dubai Air Show. But the market as a whole, you're taking a bit of a breather from the rally we've seen that's characterized most of this month. We do have a little bit of earnings to think about this week, some giant retailers reporting, but a lot of the focus for investors is on inflation. The consumer price data coming out tomorrow. The question about whether the Fed is done raising rates. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, says talk of another hike for investors is fading.
The idea of potentially peaking yields forces people to look at some places they might have wanted to look anyway, which would be some of the bigger cap tech stocks. Communication services and consumer discretionary are two sectors that do very well when bond yields have peaked, and comm services, where a lot of those tech names are sitting, looks pretty cheap.
We do check the markets for you all day long here on Bloomberg. Right now, the S&P 500 is down 0.4% or 19 points. 4396 is the S&P level. The Dow Jones Industrial Average down 0.1% or 40 points, 34,242. The Nasdaq down 0.7% or 95 points, 13,701 is the Nasdaq level. 9 of the main 11 industry groups in the S&P are in the red, led by real estate and utilities. Energy and consumer staples are the only sectors in the green right now. 10-year Treasuries down 8/30 seconds, yield 4.68%. Yield on the 2-year 5.07%. NYMEX crude is up 1% right now, up 74 cents at $77.91 per barrel. COMEX gold is little changed at $1938.10 per ounce. The euro 1.0685 against the dollar, and the yen 151.60. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live as well on YouTube. So head over to youtube.com and search Bloomberg Radio. Red on the screen as Nathan was just reporting. Let's see what's happening out there in the markets writ large. We can do that with Molly Smith, Bloomberg economy reporter. Molly, what are you looking at today out there in those markets?
Yeah, I'm moonlighting a little bit as a stocks reporter this morning, so bear with me. We'll start with the red on the screen. So I was looking at Illumina. This is a DNA sequencing company. The shares are extending a drop from last week after the company cut its full year sales and profit outlook for a second consecutive quarter. not so good over there. And a few analysts also cut their price targets this morning on the stock. So that's Illumina. That one's trading lower this morning. And then on the plus side, you gave us a little bit of a look into this, Paul, with Boeing. The shares are up as much as 5.2% this morning. That'd be the biggest intraday gain since July. China's considering ending a long commercial freeze in this market for Boeing, so that could be huge to start selling some planes over there. And as you said, they secured a major jet deal with Emirates, so good day for Boeing.
All right, that's enough stocks. What's going on in the world of tennis?
I'm so glad you asked.
Let's pivot. Just because Molly Smith is our de facto in-house expert reporter on all things global tennis. There's no major going on right now. We're waiting for that. Doesn't happen to, I guess, Australia sometime in the new year. But we can always talk global tennis. It doesn't get enough attention.
Never gets enough. So the men right now are competing in Turin, Italy for the year-end finals. This is where the top 8 teams in doubles and the top 8 singles players compete for a week-long tournament, so it really is the best of the best. Novak Djokovic, all he had to do was win his match yesterday to secure that he will be the year-end #1, and shocker, he is breaking yet another record. I was just telling you guys that I believe the stat now is that he will now have locked in more weeks at world #1 than his 6-year-old daughter has been alive. So look at that.
All right, so that's
also where the shroud is, Paul.
I know.
Yeah.
Yeah. Now, I had to say Turin in Italian.
It's just Turin? Is it
Torino?
Torino.
That was the whole thing when they had the Olympics. What do you call it? Torino or Turin?
I see. And then, hence the car, right?
The Gran Torino.
Yeah.
Oh, we can always bring it back to cars with Matt.
Yeah. So, all right. So, how old is Djokovic now? By the way, like 63. How old is he now?
No, you got to invert the numbers.
Oh,
36.
Okay, still pretty old. All right. So, I mean, that's it. And we got a lot of Americans though in the men's top, I don't know, 15 or something like that.
Yeah, 4 of them, I believe, if the rankings haven't changed too much. Ben Shelton being the youngest and the newest to break into that. He started the year outside the top 150. So pretty amazing move for him this year. We've got Tommy Paul, Francis Tiafoe, and Taylor Fritz rounding out that group. So good time to be a fan of American men's tennis.
I wonder when there's going to be, though, a new class of, like Djokovic, Federer, Nadal. They're so old, right? I mean, in pro tennis terms, they're very old. A 36-year-old that's world #1, that's unusual, isn't it?
It is. And I think Djokovic has really set out to just break every record there is right now. And, he said he's going to keep playing as long as he's still contending for majors. And he obviously is very much still in the conversation. Alcaraz would be the next best position to really challenge him, especially in the best-of-5 format. But there hasn't otherwise been a real, I think, group that has come up. Jannik Sinner would be the next that comes to mind, and he could really push Alcaraz and probably Djokovic as well. Holger Rune is another one who really pushed Djokovic yesterday in 3 sets, but they're not regularly competing for major titles yet.
Why do you say Alcaraz could push him in a best-of-5 format? Is that because just simply his age, Djokovic's age, and at that point, 5 sets is too grueling for him? Or
I meant that more in the sense of who's positioned best among the challengers in best-of-5. So, Djokovic, he's going to go all day. The guy is just, the fitness is world-class. But I think as far as the younger guys who are coming up, that Alcaraz has proven to be, so far, between him and Sinner, who's also really improving on this front, they look the ones who are the fittest to me in that format.
How about on the women's side? What's the play there? They just finished up in Cancun, right?
They did.
Not so successful tournament.
Oh,
but anyway,
God, that was such a mess.
So give us the lay of the land of the women's game.
It's really Iga Świątek, who's the #1 from Poland. Seemingly versus everyone else.
Okay.
The thing is versus where Novak is so dominant, he's usually at least being tested. Yesterday those were long, grueling sets. It was a 3-hour, 3-set win. Iga's winning sets 6-love, 6-1 pretty regularly over top 8 competition.
Yep.
So that's really the difference between her and on the men's side. But, also a great time for the American women with Coco Gauff and Jess Pegula finishing inside the top 10 in singles and doubles. So they're also very fun to watch.
All right, good stuff. Good stocks update with a little bit of tennis thrown in there. How about that? Just play to our strengths here at Bloomberg Radio. Molly Smith, thanks so much for joining us. She is economy reporter for Bloomberg. Bloomberg News. All right, let's go down to Washington, D.C., only because we have to. I mean, that's where it's all happening. Nathan Dean joins us. He's a senior policy analyst with Bloomberg Intelligence, and Jordan Fabian, White House reporter with Bloomberg News. Nathan, I just want to start with you. Are you going to shut down our government again? What's going on down there?
So, I may be a little bit out of consensus on this. We're still telling folks 40% chance of a shutdown, unless you have this temporary shutdown that bleeds over to the weekend. The reason being is that, there are so many different ideas that are being thrown around by House Republicans, by the Senate, by Ukraine and Israel and so forth. And none of these political cakes are baked. And, there's really no strategy of why you would have a shutdown at this point other than just we want to shut it down. And so with Speaker Johnson still in, what you'd call the infancy of his speakership, and obviously he made some statements over the weekend that he's seeking for more time as he does his laddered CR idea and so forth. We're telling folks, he may be able to get that. So don't be surprised if this goes in the December 15th or even January, February. But ultimately what people should know as they approach it from the market perspective is that there really isn't all that impact outside of just trying to just keep your eye on it. Even the defense contractors aren't all that exposed. I mean, we would have to see a 2-month shutdown, if not longer, for those economic impacts to be bleeding into the market. So unfortunately for a lot of the folks just watching, it's one of those political popcorn events again.
All right, so the White House has said that Johnson's plan would only lead to future shutdowns, and President Biden could issue a formal veto threat today. Jordan Fabian, you cover the White House for us. What do we expect from President Biden, and what are their problems with this plan?
I think we could see a veto threat today or something a little short of that, which is basically an advisor's recommendation that he not sign it. It's these Washington terms of craft, but we'll be watching closely to see what they say. Look, the White House is frustrated with this dragged out process that they thought should have been resolved with a debt ceiling agreement back in the spring, which set spending levels. Republicans threw that out the window, and so they're frustrated over that and the fact that there's no Ukraine aid in this package, and the White House is getting anxious that maybe this is the last bite of the apple, and so they want to exert whatever leverage they can to try to get that included, and thus you're seeing these statements that are highly critical of Speaker Johnson's approach.
But they would be, I mean, if Biden vetoes it, shutting down the government, then the Democrats get the blame for something that the whole country is angry with Republicans for right now. They're in a great situation because the country blames all of this on the other party. Do they risk that?
Yeah, that's why I think Nathan raises a good point, which is that I think you raise valid points too, which is Democrats absolutely don't want any share of the blame for a government shutdown. So my suspicion is if a CR were to reach the president's desk, he would sign it and kick the can down the road for a couple of months and try again in January to get his priorities funded. But it's still an open question of whether this laddered CR gets through the House. There's still this faction of hell no House fiscal hawk House Republicans who don't want to take yes for an answer, and Johnson can only afford to lose 3 votes. That's not a lot. So we'll be watching closely. There's some test votes coming up in the next 24 hours to see what level of support there is for this package.
So Nathan, in the interim, what legislation is not getting worked on, is not getting passed? What are we missing here?
Well, I mean, there's a lot of stuff it's more the sector level. I mean, obviously, we've talked about pot banking before. There are a lot of people who would love to see that move forward. There's really no work that's being done on it. Crypto, the NDAA, there's a lot of legislation out there that needs to get done. And we're just talking about CRs. And so ultimately, there's still going to be enough time to get that stuff done. But, time's going to run out before we get into this election cycle where folks are just going to be more paying attention to their districts. I still think that a shutdown is coming. I honestly do think that we're going to have a multi-week shutdown. I just think it's going to be in the beginning of next year because there will come a point in which Speaker Johnson and the Democrats just will not agree. And both sides will say, okay, I think politically it's best for us to just, have this fight out and let's let the chips lie. But ultimately for the Republicans right now, as you recall, last week they had a very bad week in Virginia, where I am, in Kentucky and Ohio and so forth like that. They don't want to have that happen twice in the span of 2 weeks. So I think right now that all this uncertainty is just going to get pushed into January, and we'll be talking about it then.
Jordan, let's talk about, the upcoming election. We're already seeing ads from the Biden administration trying to convince Americans that his age isn't a problem, although many people polled are concerned about his ability to get through another 4 years. What's their tactic? And what do they say about, I always wonder about Kamala Harris, because if you're really worried about the president's age, you should be doubly focused on the vice presidential candidate.
Right. Well, the Biden campaign has a lot of money right now. They have about $91 million in cash in hand. So they're spending some money now to try and get those concerns allayed and try to lay the groundwork for a broader and more aggressive pitch later next year for re-election. So they're trying to address the age question. They're trying to address the Americans' concerns with the cost of living. So if you listen to their messaging, there's ads showing Biden walking through Kyiv with his sunglasses on and talking about these things to the Inflation Reduction Act that were supposed to lower prices. But look, I think their best hope is not necessarily convincing Americans that Biden is this spry young man, but that they're going to be possibly running against Donald Trump, someone who's very unpopular and someone who's also up there in age and has shown some propensity for gaffes and the like. So it's like Biden always says, "Don't compare me to the almighty, compare me to the alternative."
Hey, Jordan, it's going to be a big week for President Biden out in San Francisco. He'll be meeting with Chinese President Xi Jinping. What's the White House? What's kind of the game plan here? What's the goal? What would be a success? What are you hearing?
They want to set a floor under this U.S.-China relationship. I don't think you're going to see a bunch of major deliverables coming out of this meeting, like some sort of agreement on Taiwan or broader economic rules of the road. Those are the two obviously main concerns in the relationship. But you could see things like resumption of military-to-military communication, some incremental things on climate, fentanyl trafficking coming out of this meeting. And I think that, again, the meeting itself is almost a deliverable for President Biden, who wants to reset this relationship in a way that puts up guardrails, make sure that tensions don't escalate out of control like they did earlier this year with the spy balloon incident.
So, all right, Nathan, from the perspective of just greater D.C., I mean, what's the concern level here just about U.S.-China relations?
Well, first, I want my pandas back. Obviously, we lost our pandas. And I'm joking there. But, obviously, when it comes to the U.S.-China relations, it comes down to clarity. That's what investors want, is they want to know what the clarity is and what's going to happen. There's